because I think a lot of the initiatives that were tucked into the infrastructure proposal, while Republicans have criticized certain aspects aren't for infrastructure, some of them you could make the case are for defense, and that's why I think I hear you on that number, but I think that you could also compare the military budget and the U.S. I think would have a different result. But it's a great point about how China's long-term investing, and that's something that Republicans are also starting to echo.
But then you look at the team that Biden has assembled to sell this. I don't see defense names. I don't see diplomats on this list. I mean, these are still some heavy hitters. You got Marcia Fudge, Marty Walsh, people like this. But these are domestic economic cabinet members here. Why aren't we seeing more folks there who can sort of pitch the foreign policy side, the benefits of this?
Romaine, that's such a great point. And look, I think quickly 2 points on this. First and foremost, the administration is looking at the domestic side, and clearly they're trying to make a union pitch for union workers domestically in swing states and Rust Belt states and in parts of the country that they were able to win in 2020 in order to form a broader coalition. But then secondly, I think you're absolutely correct. And I think that, again, in where the business actually gets done in Congress, that President Biden knows with Leader McConnell is going to be perhaps in the more military spending angle of this.
Kevin Cirilli, Fareed Zakaria has a fabulous essay in the Washington Post this morning on what all this infrastructure costs. And in the defense of the conservative Republicans, the numbers are mind-boggling. He goes back to the George Washington Bridge, 1931, on time, on budget. The Long Island Railroad is the most expensive piece of railroad in the world, etc. Do we have any confidence this money will be spent in any kind of efficient way?
You know, look, I'm the son of a civil engineer, so I remember.
Well, then we're asking. Give us the statics and dynamics of this.
Roll out the blueprints at the dinner table and walk me through the layouts. Look, I think when you talk to that portion of the world, and earlier this week, Taylor Riggs and I interviewed the leader of the American Civil Engineers Society. I mean, they would raise the issue of permitting processes. And so I think that this is a really complex issue about just the timing of all of this. But there's no doubt that Biden's trying to juxtapose a new type of job in a green economy, as he lays it out, with the manufacturing hustle and grit of the American worker of yesteryear. We'll see if he can accomplish that mission.
Kevin Cirilli giving us physics this morning. Let's go back to first principles with his father. Cirilli lectured at the table on S equals VOT plus 1/2 GT squared.
Yes.
You know that, do you, Kevin?
My dad taught me everything I know.
Yeah, there it is. One of the core physics principles here. Brad's in the control room
going,
what is S equals
For every action,
VOT?
there is an equal reaction.
Very good.
There's people on the set going, what the heck are they talking
Physics with Kevin.
Over to the audience, too.
Tomorrow, Kevin, go away. Kevin Cirilli with us. Thank you, Kevin, for joining us on Good Friday. Seriously, greatly appreciate it. This special coverage, folks, for you. This Jobs Day, and we'll be here at 8:30 with good conversation afterwards as well. Romaine Bostek, of course, Lisa Abramowitz, and where's Lisa John?
What, didn't you say that he was going back to Capri?
Yeah, I think he went to Capri, actually.
He wanted to give Romaine a shot at the podia because it's really fun to see.
He's at the podia as well. What's important there, and you know, well, we got to go here to break, but I really want to come back and talk about this, about the expense of all this, the efficiency of all this, and what we're going to do on it. I mean, it's a great thing. Romaine,
we'll talk about the expense. I mean, you mentioned the GW Bridge, you mentioned the Long Island Railroad. I mean, what were the dividends that came out of that? I mean, everyone talks about the cost, but does anyone actually talk about the long-term benefits?
Yeah,
how did you get to work, Tom?
Yeah, you're absolutely correct. It's a long-term benefit in the timeline. There are long-term benefits to give you data checks. Well,
sort of.
Futures are sort of there. Bonds are sort of.
You could do it, Tom.
FX is there, dollar fractionally weaker. It is Jobs Day. Stay with us. This is Bloomberg.
shadow minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
Madame Lagarde, has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly playing out at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim. We're going to be riveted to that, and we're going to do what is required.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Good morning, everyone. Bloomberg Surveillance. Good Jobs Day to you worldwide and across this nation. A special edition of Bloomberg Surveillance. Tom Keene, Lisa Bramos, and John. Oh, no, John's off. A well-deserved vacation. The first days of the year that young Pharaoh has taken off. And yes, he's enjoying the shores of Capri. Romaine Bostic pulls a short straw this morning. Romaine, I want a picture right now away from what we're going to talk with Carl Riccadonna about the equity markets. We've got earnings coming out. 331 is the end of it. The earnings pile in here in a number of days. What do you look for?
Earnings expectations going up, Tom. CapEx spending going up, Tom. Margins are expanding as expected, and this is a big part of the reason why you're looking at an S&P 500 at a record high at that psychological 4,000 level. You talk about valuations. You talk about has the market priced in too much too soon, and everyone we talk to on this afternoon show, I know you guys stay up to watch that big afternoon show every day. Bloomberg markets are closed, and everyone we have comes on, they basically say the same thing. They say the growth is there. The growth is there to justify some of these valuations, and that we're on the precipice of something that is a lot more structural and a lot more long-term.
But this is critical, Romaine. All my radar's up if everybody's on the same page. What is going to be the use of cash of corporations into Q2 of this year?
Well, in this political environment, I don't think it's going to be buybacks and dividends that we saw
you think
during
they're
the
going to
previous
spend
cycle.
The money?
Yes, I do.
That's the thinking. Can I just note
Lisa,
that how many teases are you going to get in plugs for your show? We're going to have
a lot. We're only in the first hour.
I know, and you're still managed to get a real good doozy in there. I think that there is a question, though, of course, in participation with equities, and I think that is going to be an increasing question. The number of retail traders involved has been plummeting over the past couple of weeks, even after the checks went out in the mail from the Biden stimulus, and there is a question of whether.
Does that, Romaine?
I mean, look, okay, if you want some gloom around the frog, I mean, the idea here, I mean, I'll bring it.
She does this
but
every
Romaine,
day.
I mean, honestly, at a certain point, yes, I do. There is this question of whether all of those earnings surprises have already been baked in.
Well, let's get polite here. Let's bring in Carl Riccadonna, Bloomberg Economic Chief U.S. Economist, is going, why am I up today? Carl, I want to go back to laminar flow and the correlations of aerospace engineering, of which you and I darkened the door years ago. We're going to do aerospace economics with Carl Riccadonna right now. Carl, the problem is aerospace is always about looking at the degrees of freedom and the margins of error that can be. What's our margin of error right now? What is the thing that's not giving us degrees of freedom? What's the worry forward?
Well, I think one of the constraints here is that the U.S. economy and developed Western economies in general aren't built or used to operating at such breakneck speeds. I mean, we're looking at an economy this year growing almost 8%. The second quarter is going to see growth of about 11%. So this is like taking a an old-fashioned, Fokker biplane and taking it to supersonic speeds, there really are some limitations as you grow at speeds that you haven't seen in more than a generation, really. And so that's going to cause supply chain bottlenecks, frictions in the labor force, all these sorts of things that could send potential false signals, because we're not upshifting to those types of breakneck speeds on a permanent basis. It's just a re-acceleration or reopening of the economy.
Really well said there, as we would always expect from Mr. Riccadonna. Carl, if that is the case, the idea here, the certitude that we're in a continuum of a boom economy, well, you go, no, maybe not. What is the worry that you have given a boom economy? Is it the x-axis, the timeline, or is it the y-axis, the different things moving around?
Well, I think it's a combination of the two, and really it's kind of a continuation of the question you asked Julia Coronado at the top of the hour, and it's how much faith do we have in the economy after the fiscal stimulus frenzy has worn off, and now we have the infrastructure plan promising to add a bit more funding to the economy. But I think the confidence we can have is the fact that the Fed has learned from its past mistake, and that past mistake, surprisingly, was that it took accommodation away too swiftly in the last cycle. And you can say, well, Chair Yellen moved at such a tortoise-like pace in terms of interest rate increases and pulling back on quantitative easing and whatnot. But nonetheless, that proved to be faster than was warranted in the economy, because we never got the inflation pressures. So I think one major, two major considerations we have to take into account as we think about what the economy looks post-reopening, as we get into 2022 and beyond. Number one, that we have tremendous fiscal lift this time around, whereas back in the recovery from the global financial crisis, we were really too stingy with fiscal stimulus, and that caused a lot of problems in the economy. So that problem's eliminated. But really the sustainability question has to do with the fact that this is not a Fed that's going to pull back too soon. It's gone from seeing the whites of the eyes of inflation to really seeing the tails of the coat of inflation. And so the Fed is going to let this economy run hot and create some wage pressures to prove that the Phillips curve still is something that can work here in these modern times. And that's going to have tremendous implications for growth being diversified throughout the economy across the demographic and the income spectrum, and also potentially leading to a faster pace in the later years of this cycle compared to the later years of the last cycle.
Carl, weigh in on the Morgan Stanley view that the economic recovery is going to burn real hot and it's going to burn real short. And this seems to be gaining a lot of steam here. The idea that the higher inflation rate and the froth that we've seen in certain stock areas will lead to a bigger and perhaps sooner decline.
Well, I have to agree with that assessment. We're certainly going to burn hot, growing at a 7.7% pace this year, probably about 4.5% next year. But I don't think this is a reason to think that this will be a shorter economic cycle, because that period of burning hot is not going to cause the type of inflation that causes the Fed to step on the brake pedal. And so I think this is a very patient Fed, so long as we have Jay Powell or someone like Jay Powell at the helm, and that means that the Fed's not going to step on the brake pedal, and this cycle can be just as long, if not longer, than the previous economic cycle, as we really stretch the dynamics of letting low unemployment start to create some wage pressures in the economy. That's a very difficult train to derail once you have some positive growth dynamics for the feedback loop between prices and household incomes.
But Carl, square that circle then. I mean, we're talking about the length or the potential length of this economic cycle here. Talk about the robustness of it, because a lot of people are saying, yeah, we can go longer, even in a sort of a run it hot type of environment with regards to inflation. But the idea here is if we do get that sort of hotness, as you'd say, that's going to tamp down the actual growth rate itself. It may persist for a while, but it's going to be low.
Well, I think it will potentially tamp down the growth rate, but in a healthy way, returning us back to a sustainable pace of growth. Certainly a little bit more inflation in the economy than what we saw in the last cycle would be healthy development for interest rates, which then factors into financial stability, which then factors into the ultimate sustainability of the economic cycle. So if we're in a low growth, low inflation environment with rock bottom interest rates, that's actually not that healthy because it causes froth in financial markets, as we saw in the last economic cycle. This time, letting things diversify a little bit, run hot for a longer period of time, bake some inflation expectations back into the system, pushing some credit spreads wider. That's a very healthy development for a mid and late cycle economy, and I think letting that develop this time around will really have some profound consequences, not just for the cycle but structurally.
Yeah, well said. I want to get your thoughts here on the productivity question, and a lot of theories out there here that the resurgence or reemergence of productivity growth could actually be kind of the wild card here that could make this economic cycle much different than the last.
Absolutely. We've been in a slowing productivity and a low productivity environment for the better part of 40 years, Romaine. And so it takes tremendous capital investment to turn that around. So as big as that $2.25 trillion infrastructure package from the president is, I'm not so sure that really is going to move the needle to a great degree for the long term. But Romaine, you lucked out because 99 out of 100 economists would tell you that we can't really forecast productivity over the longer run. And you lucked out because you got the one economist who says, yes, we can model productivity. And the way we model that is through labor costs. If labor costs are low, as they have been in cycle after cycle, because we've been questioning whether the Phillips curve actually works and the Fed's been tightening too soon, there's not a lot of incentive to enhance productivity. If we let the economy run hot and let wage pressures increase, then businesses are incentivized to work around rising labor costs and invest in productivity enhancing capital spending. There's been little need to do that because wage pressures have been so stagnant over the last couple of economic cycles.
Carl, thank you so much. Carl Riccadonna with Bloomberg Economics. I got about 4 more questions. We'll save them for the next time. On this jobs day with futures up 9, Dow futures up 33. And again, it's going to be an interesting trading day as well. Romaine, explain the trading day. Why are we here?
I don't know. I've been having that question myself. It looks like Farrell was the smartest one in the room here. But look, I mean, look, you got, oh my gosh.
Wow, that was more.
All right. We'll come back to that, Tom. But we talk about, look, I mean, the futures markets, you can trade that if you want. You'd be kind of silly to do that. You are going to get a little bit of activity here in the bond market starting around 8 a.m. here on New York time. But look, there are a lot of people who do want to position out of this jobs report. They need that opportunity to do that. And look, they'll get an opportunity to do that. Whether we get a surprise in that jobs report will determine just how much activity.
Can I just say, Tom, this is an incredibly human jobs report. I mean, they all have been, but this one in particular, this idea that people are going out and traveling more because they can, the idea that people who are home with their little lovely hellions, who are getting some conviction that they're going to go back to school in person in fall, can go out and perhaps get jobs. This is what this report is going to highlight. And I think that this is going to be the nature of a robust recovery after a shocking shutdown and the economic ramifications.
See this, Romaine? The Abramowitz brats are saying, Mom, why are you working Good Friday? I mean, that's
pretty much, right on.
Pretty much got that right.
Yeah, you got that right, Tom. Keep going.
Well, we are here, and we're thrilled you're with us here. We say good morning across this nation and around the world. It is Jobs Day in America, and as Lisa really alludes to, and it's really quite serious, this is the month where there's expected to be a liftoff. We're in the 600,000 range. It's a blended survey, but we've seen a lot of recalibrations higher than that. Let's remind ourselves a normal good month was 200,000, 225,000. And in this recovery of the American labor economy, well, guess what? Maybe 1 million jobs today. We will see. Please stay with us on the pandemic and on our recovery. Andrew Pekosh, Johns Hopkins University. This is Bloomberg. Good morning.
With the First Word News, I'm Ritika Gupta. The U.S. government is out with the March jobs report at 8:30 a.m. New York time. The economists are expecting a strong one. According to the Bloomberg survey, they're forecasting that 650,000 jobs were added last month. That would be the biggest increase since October. OPEC and its allies have expressed growing confidence in the global economic recovery. They agreed to increase oil production gradually in the coming months. The group will add about 2 million barrels a day from May to July. The big oil producers are now convinced that fuel demand is on a firmer footing. There will be a semiconductor summit next month. White House economic and national security advisors will meet with chip makers and auto companies to discuss the global shortage of microprocessors. The Biden administration is reviewing supply chains for chips and other products. And the $100 billion SPAC boom is shifting fortunes on Wall Street. It's knocked some of the world's biggest banks off their perches. Cantor Fitzgerald has been the biggest beneficiary of the blank check company craze. The boutique firm ended the first quarter as the 10th largest advisor on IPOs. It hasn't been ranked that high for a full year in a decade. Citi jumped to number 1, whilst UBS fell out of the top 10. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Nobody wants to see vaccine inequity continue in the world, and that the idea that 70% of vaccines today have been administered only by 10 countries is really not acceptable. It's not acceptable that there are poor people or poor countries being left behind.
Really important comments there by the Director General, Ngozi Okonjo-Iweala. This is really important, and we say good morning to Peter Hotez down in Texas, who's really led the charge on this show on this. How do we get this medical technology distributed around the world? It seems to be a new challenge as some do better than others. We welcome you all on this Good Friday. The market's in some ways open. The bond market, Romaine Bostic says, open at 8 a.m. Then we'll move on to the jobs report at 8:30. It's a different day. Romaine Bostic in for Jonathan Farrell, Lisa Bramowitz as well. Right now we're going to digress, and Lisa's going to drive this forward because, frankly, she's more up to speed on it than I am. And this is about blood coagulation. It is a really serious issue among the pros looking at the treatment and how do we get through this pandemic. And Lisa, there's been important news from the United Kingdom.
Well, this has been the issue in Europe, right? The idea that the AstraZeneca vaccine, which is the dominant one in the Euro region, has had incidences of thrombosis, of this blood clotting, and this has led to halting its use in a number of different nations. The UK now coming out and saying that there are 25 additional blood clot cases. Again, the regulator there saying that the benefits way outweigh the risks, but really highlighting whether this is a PR miss for one of the main vaccine producers or whether there is something more substantive behind some of the warnings that we've seen on the continent of Europe. Andrew Pekosh has a lot of perspective as a virologist and longtime studier of these types of viruses and, frankly, of COVID. He even has a stuffed COVID molecule behind him. Andrew Pekosh, Johns Hopkins School of Public Health professor and virologist. What's your sense, Andy, about this AstraZeneca vaccine? Is this materially more risky than some of the other inoculations out there?
Well, I think there's two important things here. One is these issues of blood clots have come up a couple of times now with AstraZeneca, and independent review boards have not made the connection between the vaccine versus the natural, perhaps low rate of occurrence of this type of disorder in the population. So so far the evidence hasn't pointed directly to a link. This new report, of course, is something that is clearly has to be investigated. It's important to note that the vaccine safety monitoring system is picking these things up and registering them. And, we'll have to then let the independent review boards really look at the data to see if it really is an association with the vaccine. As we immunize millions upon tens of millions of people, these very rare vaccine-associated events are going to come through as a trigger. And the important thing to keep going on is understanding how that penetrance is, how low that penetrance is, and weighing that cost-benefit analysis.
But Doctor, the heart of the matter is in April, as we celebrate all the work you and your profession has done, is so many people in America are afraid of the science. They're afraid of the technology. They're focusing on the missteps. How does your profession get a confidence among those that want to trust you but don't?
Well, personally speaking, I know that when I've met with individuals who have some doubts about the vaccine, oftentimes the first thing is just getting the right information, getting the right data, getting the right sources to reassure them, to answer their questions. I think one has to approach the general population with exactly that in mind. We have the data, we have the information, we just have to convey it to everybody in a way that they can appreciate and understand. I think the second thing about this is, this is now going to turn into a public relations campaign with respect to conveying that information as effectively as possible to as large a population as possible. It's a fantastic thing that we're up to immunizing over 3 million people a day in the U.S., and the supply chains of vaccine indicate that we can immunize our population and essentially eliminate the risk from COVID-19 within the next few months. But that has to involve engagement of the population to make sure that they're comfortable and understand everything that has gone into the rapid development of these vaccines.
Yeah, Doctor, I'm glad that you hit on some of the bright spots here about the number and the pace of vaccinations that we've seen so far. I mean, I've done a lot of cajoling in my family to get my family members out there and get vaccinated as well. Is there sort of a level, a threshold that you're seeing out there that we might hit where that's basically all we're going to get? There's going to be a certain percentage of the population that for one reason or another isn't going to do this. At that threshold, are we going to be able to live with that, so to speak, with regards to keeping the new caseloads down?
Yeah, so one of the numbers that I've heard some of my colleagues who model these types of vaccine effects said is 70% of the adult population in the U.S. is a target for immunization for us to start to see the maximum benefits of vaccination. Right now, the data out there that I've seen in terms of polls suggests we're getting close to that level of acceptance in the adult population, but that still leaves a lot of work to do. And importantly, the issue of equity is something that we need to have a lot more work on, because the acceptance rate among different socioeconomic groups and racial groups is very different.
Andrew, nobody cares. Okay, here's the reality, Andrew. It's the Red Sox-Orioles opening day at Fenway Park today. Isn't the best public relations for those scared is to line up Yastrzemski and Ripken and have them get some form of vaccination?
Well, as a Red Sox fan who lives in Baltimore,
I'm
cautious about what I say.
Who did that?
But your point is absolutely correct. We need to engage everybody on this.
Tom is still looking for someone to blame for this.
Wow.
Yeah, this is what happens. Andrew Pekosh, thank you.
You've dumbfounded Tom here. He's speechless.
I'm just trying to.
Are you still there?
I'm just trying to. A Red Sox fan in Baltimore? That sounds like a bad song. Andrew Pekosh, go away. But John Hopkins, Andrew, my deepest sympathy. There it is. Romaine, I'm speechless.
This doesn't happen, Romaine. Just letting you know.
Oh, really?
No,
this is the first time.
This is the first time.
So was that my moment to shine here? Should I have just slipped in another plug for Bloomberg Markets to close there?
Jane Sherman was a very famous doctor, and she was a diehard Orioles fan back when they were the St. Louis Browns and almost on to the Baltimore. She taught me about rooting for last place.
Oh, really? And you never been the same. I do want to just bring you some additional news. The idea that J&J is expanding
back on the rails, Lisa?
I'm doing
Very
the best
nice.
that I can. Thank you. Basically, they're expanding their trial to adolescents. They're trying to include younger cohorts after earlier data showing that the Pfizer vaccine was incredibly effective, 100% effective in kids ages 12 to 15. The idea here, it is huge because getting kids back to school.
Lisa, preach.
I'm preaching,
all right.
and I'm telling you. And Tom, you're in the same boat. But the idea of getting them back to school is crucial for everybody.
Well, it's all gone at light speed. We got to remember this is usually a 1, 2, 3 year period. I mean, Romaine, all of us are dealing with this. That's all there is to it.
Yeah, but getting the kids back to school, I mean, that's just so important. I mean, ask my wife.
I just want them to take a shower. I'm looking for the April. Can we have the April shower now? Okay, we can do that.
What, because of the Baltimore fan?
Yeah,
who's a Red Sox fan?
No.
He can't get over it.
A Red Sox fan in Baltimore? It's Jobs Day. Stay with us. All you Oriole fans. This is Bloomberg. Good morning.
Fascinating.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We're actually in the period right now where the global economy is starting to accelerate and growth numbers are positive.
It's very mechanically driven, completely unnatural as far as recessions go. So now the recovery is somewhat unnatural as well.
All those who were saying that we were going to get inflation like you've never seen so far has been proven wrong.
I think we're going to see the strongest economic growth in 50 years during 2021 and 2022 combined.
At the stock level, we're expecting disappointment. I mean, we think it's going to be difficult for a lot of companies to manage this.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance, Jonathan Farrow, Lisa Abramowitz, and Tom Keene on this Jobs Day. Mr. Farrow, a well-deserved sabbatical off the shores of Italy. We're thrilled that he's made that sojourn. The short straw this morning. You know, we looked at a lot of different people to come in, and Romaine is the unlucky one. We're thrilled he's with us. And seriously, Romaine, we have a lot to talk about in the equity.
No other place I'd rather be right now.
Sure.
Oh,
Thank you. Nailed that. We're an hour and a half away from the jobs report. We will do economics here. But to be honest, we're focused on the linkage of this boom economy back into what we see in the equity markets. Priya Misra to come up with important fixed income conversation in a moment. Lisa, it is a boom economy, isn't it?
It is a boom economy. The question for how long? And yesterday I want to note, and this is just a one-day move, so we don't want to make too much about it, but you did see the biggest drop in break-even rates over the next 5 to 10 years going back to November. What does that mean? This, to me, raises questions about the hot and short economic cycle that Morgan Stanley keeps talking about. The idea here that if we are running hot, does that end this economic cycle earlier? Kara Kadana from Bloomberg Economics saying no. But this, to me, raises questions about the long-term neutral rate, which seems to be getting ongoing concern and consideration by bond investors.
Romaine, you and Taylor Riggs are knee-deep in the cadence of corporate officers. What are they messaging as they go into the Q2 earnings season?
Well, they're messaging a lot more spending, a lot more CapEx spending, a lot more research and development spending. You know, I think it's interesting, too. There's a disconnect here, but I think and there's always a disconnect between the economists and the markets. But I think you're seeing a big divergence here in terms of how people are viewing the length of this cycle that we're in. You have economists basically talking us being at the start of a cycle, and you got market participants saying that we're basically in the middle of one right now. Somebody's wrong here, and it'll be interesting to see.
This is a really important question. I had this yesterday, and afterthought turned to me and said, "What about SPX at 4,000?" And I said, "I don't know. I'll ask Romaine."
Did you celebrate the other day?
Yeah, afterthought was all over it as well. But Romaine, I'm looking at futures up 12, and folks, futures open. I don't know what equities
futures
doing.
are open. There's no volume.
There's no volume. Whatever.
There's no volume. Euro dollar unchanged.
What's the symbolism of 4,000?
Well, I mean, look, these round numbers always provide some sort of psychological boost. I don't know if it's really the 4,000 level so much as it is the fact of the consecutive record highs that we've managed to hit here, especially after we had that little bit of a lull in the middle of March where a lot of people thought, well, okay, maybe this bull market had sort of run out of steam here. We talked about this a lot on Bloomberg Markets to Close. We had the cheap champagne, the balloons, and the T-shirts. And look, at the end of the day, it's really, Tom, hey, it's all about really as to where we are in this economic cycle. And again, a lot of market participants are looking at this as being more mid-cycle, and yet you talk to the Carl Ricadanas and some of these other economists, and they're saying, no, we're just getting started.
Lisa, what's so important here is a confirmation in the fixed income market. Full faith and credit can lead, but is IG and high yield, are they confirming the equity enthusiasm?
100%. The riskier the credit, the better it is. And actually, it's been the best performing area, the triple C area, area, the area of companies that are closest to default, people saying that they're not going to default. And the question is, are they going to be right? Are we going to get a repricing as benchmark rates go up? Let's just get through a rundown through what we're expecting this morning at 7:30 a.m. We do have Ellen Zentner in about a half an hour joining us from Morgan Stanley, the chief U.S. economist. They've gotten it right again and again. The very hot and very short economic cycle call is one of the pivotal calls of the moment in terms of how long can this inflationary push go? How far can this job surge continue for? At 8:30 a.m., we'll get that key U.S. March payrolls report. The spread between the low estimate and the high estimate, just astronomical, nearly 800,000 difference there. And the idea here being that we don't necessarily have a sense of how quickly we are reopening and how quickly we're getting people back to work. And then 9:30 a.m., U.S. Labor Secretary Marty Walsh is going to be speaking here on Bloomberg Television. Interesting to see, and I was talking about this earlier, I really do think, Tom, the optimism of a booming labor economy with the caution that necessitates a $2.25 trillion spending plan. Yes, Tom, what do you have?
You got it all wrong. Mayor Walsh is on the show because it's Orioles Red Sox opening day.
Is that what we're talking about?
That's what we're talking about for the rest of the morning.
It's a national. I remember the time.
Oh, dear Lord.
Here we go. Best opening day I ever saw at Fenway Park was Jack Morris and Roger Clemens in Romaine. The great Jack Morris of Detroit walked off the field and 34,000 people stood up. It was absolutely spectacular.
This is what happens when the markets close. I think that the bond markets do open, though, pretty soon.
Priya Misra's going, why did I book this today? Joining us now, Priya Misra, TD Securities Global Head of Rate Strategy. Priya, I look at full faith in credit right now. Lisa mentions a joy in a high yield. Is full faith in credit linked to the equity and boom economy enthusiasm?
I think there's absolutely some of that. I mean, it's not just an equity, it's an economic optimism. We have the vaccine pace that's accelerated fast. And then we have record fiscal stimulus. And then just this week, we heard about another plan, and we expect another $1.5 trillion infrastructure plan to follow. So we're looking at $4 trillion in combined gross spending. So I think the bond market is saying we've got good data, we've got an inflationary risk. And I think that's why the curve has been steepening break-evens. I know Lisa was talking about that. They've been going up. And we've got a ton of supply. Who's the marginal buyer for Treasury? So I think the market's pricing in these macro factors. I do think they're a little bit early in the Fed, expecting, I think the market right now is pricing in the first hike in early 2023. Yeah. That seems a little early. So we're extrapolating this good data continuing all through next year. I think that might be a little too optimistic.
All right, Priya, aside from the headline numbers, what's the most important thing that we're going to learn from today's jobs report?
Well, so we're looking for 1 million. So the headline number is important. I think the Bloomberg consensus around 600. Headline's important. We'll be looking at participation rate. One of the things Chair Powell and the Fed in general is talking about is an inclusive labor recovery. Are we seeing signs of that? As the COVID restrictions are stepping away, is participation going up? Are we seeing the most COVID-impacted labor market sector starting to improve? We think that's going to happen through the course of the year, but just much slower, because you've got these big questions, right? How quickly do consumers rush out? You get a vaccine, do you just go out? We get herd immunity. How quickly are savings run down? How quickly does the service sector pick up? So I think the headline number is actually increasingly going to become less important, because we'll be looking at these other signs.
Priya, in about, 12 minutes, 22 minutes, something like that, we're going to be speaking with Ellen Zentner of Morgan Stanley, who's been talking about this burning hot and burning short cycle. Do you think the bond markets are confirming that thesis, that basically the faster this recovery, the shorter this economic cycle will be, and the more quickly we'll get back to this real rate of inflation, this real rate of basic yields that is quite low?
Right. I think real rates are a little low because most of the move has been inflation expectations. But now I think the bond market is really pricing in these two outcomes. And these are very big macro questions. Are we at the start of the cycle and that's going to continue? Or is it that short? I would say if the market's pricing in a Fed hike in early 2023, it's pricing in the continuation of growth. So I think the market is pricing in not necessarily such a short cycle, because the Fed knows if it's such a short cycle, maybe they shouldn't rush to exit or taper. So we've got a bunch of things the bond market's pricing in, including tapering supply. We have to attract people to buy every auction. We've got tons of treasury auctions out there.
And so, Priya, I mean, you go back to Lisa's statement here about triple Cs. I mean, we used to deride this stuff as junk. Now, apparently, I don't know, it's apparently what you want to invest in now. Is that what you... Expensive junk, right. Well, expensive junk that's doing well and presumably doing well because of the rising rate environment here. Disaster averted, I guess, with regards to the economy here. The idea that we're building back or building ourselves back out of this hole that we're in, do you still look to some of those lower tiered credit out there as providing positive returns going forward?
So we're getting a little bit nervous because I guess we're in the camp that growth is, it's a very strong reopening related growth right now, but it's going to be still a long haul to really recover that quickly and to get inflation higher. Where I'm also a little bit nervous is around bond market outflows. Do we start to see fixed income outflows because of the rate move? Not because people are concerned about credit, but there's real and high duration risk in some of these IG markets. So I think you got to be a little bit careful, have some liquidity on hand in case you start to see the outflows. But overall, you know, there's a reach for yield. And we think as much as the market's pricing in a Fed hiking soon or tapering soon, that they'll be really slow in the exit.
Really interesting. And to see what real yields do here, not you know, today or over the next month, but it's going to be fascinating to see over the next 6 months how real yields and that negative real yield migrates back to zero. Priya Misra, thank you so much with TD Securities.
Thanks.
And Global Head of Rates Strategy. You know, we're making, you know, a chat of this. And Lisa, let me go to you on this to start the conversation quickly. And that is, it is jobs day, and we're folding in where we are, end of a Q1 into Q2. And there's just this assumption of a boom economy. And that's just that, an assumption.
It's an assumption because we don't have the data behind it, and perhaps we'll get the confirmation. And it's going to be, to quote John Farrow, is show me the money, show me the data rest of the year. That guy over in Capri. I do want to just make one note of Priya's comment about the outflows from fixed income.
Yeah, what's that mean?
Taking a look at some of the withdrawals from the big investment grade funds, LQD, one of the biggest ETFs in the field, saw more than $10 billion withdrawn over the first 3 months. That's basically a fifth of the overall outstanding assets. The why is because you got rate sensitivity. You had the worst performance in this particular asset class since 2008. You had the worst performance in treasuries going back to 1980 with expectations that you'll continue to get weakness.
Brilliant.
Why do people want it? It's not going to be a ballast for the portfolio or a hedge against equity volatility.
Where else are you going to put your money?
Well, Romain, quickly here. What's the equity bet right now? What do you see in ETF flows?
Well, in ETF flows, it's still going into some of the more stable companies, those big mega cap companies that everybody sort of pushed aside and said, oh no, go for the small cap growth cyclical names. No, that's not where the money's going.
Well, it's interesting to have you with us on this Good Friday. We welcome all of you across the nation and worldwide. As Romain Bostic with us this morning in for John Farrow. We really thank you all for listening and just thrilled that we're spanning the age groups as well. One of our viewers sends in a photograph. There we are, lined up.
Look at that.
Look at this. This
she looks so pleased.
She looks riveted.
Dominica, wait, it looks like a police lineup.
I know.
Baby Dominique just crushing it this morning. We're going to crush it in the jobs report. Ellen Zentner later. Stay with us. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. If economists surveyed by Bloomberg are right, this could be the strongest U.S. jobs report since October. The median forecast, 650,000 increase in payrolls, and the crowd-sourced whisper number has risen to 800,000. The March jobs numbers are out at 8:30 a.m. New York time. Iran and the rest of the world powers still in the 2015 nuclear deal will discuss a possible U.S. return to the accord. There will be a virtual meeting today amongst those taking part, the EU, China, and Russia. The U.S. says it welcomes the effort. Iran has insisted that the U.S. must drop sanctions as the first step. In Taiwan, the deadliest train accident in decades. At least 48 people were killed when the train derailed at a tunnel on Taiwan's eastern coast. Railway authorities say the train collided with an unmanned vehicle that had rolled down a hill. More problems for the AstraZeneca coronavirus vaccine. The British government now saying there have been 25 new reports of blood clots linked to the shot. That adds to the numbers that caused European countries to impose restrictions on the vaccine in the first place. Pioneer Natural Resources is expanding in the Permian Basin. It's agreed to buy Double Point Energy in a deal valued at $6.4 billion in cash and stock. It's one of the biggest American oil takeovers of the year, and it comes less than 3 months after Pioneer bought fellow shale driller Parsley Energy. BlackRock CEO Larry Fink got an 18% pay rise last year and almost $30 million. Fink's pay included deferred compensation of almost $4 million and a long-term incentive award of $14.9 million. BlackRock ended 2020 with a record $8.7 trillion in assets under management. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Those tariffs have worked insofar as they have leveled the playing field for American producers of steel and aluminum, and that's what they were intended to do. So I'm not saying that they're perfect, they've created other challenges, but the fact of the matter is, China doesn't play fair. They'll do whatever it takes, and we need to use the tools in our toolbox to level the playing field so American workers have a shot.
I will not mince words. Gina Raimondo of Rhode Island, she is the most qualified Commerce Secretary we've ever had. Whatever your politics, it is a wonderful pedigree out of Harvard, of Dr. Raimondo of Oxford, and of course her JD from Yale University. Gina Raimondo there helping Mr. Biden move forward our commerce. Kevin Cirilli joins us right now on this Good Friday, and of course a jobs report here in a moment. Kevin, do the politicians care now about the unemployment rate, about the job statistics, or are they just so taken up with the fiscal battle leading to the politics of 2022?
No, I think they definitely care. And yesterday, when I interviewed Commerce Secretary Gina Raimondo, I was really struck by that answer that she gave to me, just about the broader, longer-term strategy here. Because I do think that from an economic standpoint, Republicans and Democrats are really going to be messaging around China, albeit from different perspectives somewhat, but it was really striking to hear someone with such foreign policy, international business experience, and of course, she's the former governor of Rhode Island, to talk tariffs in a plain-spoken way that really effectively communicated the message and really made tariffs nonpartisan in her response to me.
I mean, the distance from the dockside to the Black Pearl in Newport, Rhode Island, Kevin, has been measured numerous evenings. I might point that out. We say good morning to everyone up in Rhode Island. But, Kevin, the distance from Rhode Island to Kentucky, the distance of Rhode Island to Arkansas speaks of the divides of this nation. How does a president, how does a Secretary of Commerce bring everyone together around a Biden infrastructure bill?
Well, I think that, you know, and I think Washington knows this, and Leader McConnell knows this, and anyone who's done business in the halls of Congress understand that the top line water cooler political back and forth of the day truly will not impact the ability to get pieces of this infrastructure proposal through, especially on the semiconductor chip portion of this, which I believe is at about $50 billion worth for semiconductor chips. We should note that President Biden is set to convene a semiconductor chip meeting April 12th, just next week. And that will come just 10 days before that virtual summit with the Alliance of Democracies, as he's calling it, in addition to a virtual meeting on Earth Day, April 22nd, with Xi Jinping. So a lot's moving in the supply chain front that I think is a really nonpartisan issue. Yeah. And it's fascinating to see each twist and turn as we get closer to April 22nd.
Yeah, unfortunately, Washington always has a way of making everything a partisan issue. We saw that, of course, with the last fiscal stimulus. And we talk about what's in this proposal here. There are a lot of proposals here that, I mean, at least behind the scenes, Republicans will tell you they're all for. Now, they may quibble over how to pay for it and whether, you know, you should be raising corporate taxes to do it. But whether you're talking about the chip shortage, whether you're talking about the boost in EV charging stations, everyone I've talked to says, hey, they love this stuff. But then publicly they say, okay, there's not going to be any Republican support for this. What's the salesmanship that this Biden administration has to do to at least peel off 5 or 6 of these folks and get them on their side?
Stick it in the defense reauth, or stick it in the New Frontier Act, which is something that Majority Leader Schumer is rallying support for, which is bipartisan. I've heard through the grapevine that Senator Chris Coons, a Democrat from Delaware, is also potentially putting together some type of bipartisan China legislative package towards the end of the year. But again, I think the fourth quarter of this calendar year is when you'll start to see some movement. But put it in the defense reauth, which typically is an easy pitch and not nearly as controversial. Now, we should note, former President Donald Trump, there were some political theater around it, but I wouldn't anticipate that this go around.
Kevin, some people might be wondering why we're here today. We're here today because we're getting a jobs report in about an hour's time, and you are praying. I am wondering, though, Kevin, and perhaps it's Good Friday, so it's fitting, but there is a question of whether a really big number is good for the Biden administration because it edifies their sense that they're helping the economy recover, or it's bad for them in that it gives them less clout when they're trying to lobby for their $2.25 trillion stimulus plan.
You know, candidly, any Republican or Democrat will tell you a good jobs number is a good Friday. And so I think everyone would want, politically speaking, a good jobs number. It adds momentum in terms of the economic recovery. But to your point, I think, a lot of folks have been talking about inflation. A lot of folks have been talking about whether or not, as the economy continues to recover, that's evidence for more or less spending. We saw that last month when Republicans said that there was evidence that as the economy reopens, that's the best way to shore up the economy and get the economy back on good footing. But Democrats would argue that, hey, we got to keep investing in the future, especially at a time when China has continued to do that for decades.
Kevin Shirley, thank you so much, our chief Washington correspondent. Of course, on this jobs day, the political ramifications as well. Lisa, I look at the data coming in, and this is sort of the first month, I would say, where there's really an anticipation. Would you agree, Lisa, the gap here is the survey 650 up to the effervescence of those million number statistics?
Yeah, but what's interesting is that yesterday we got those initial jobless claims that came out higher than expected. We had Neil Dutta of Renaissance Macro coming out and saying, fiction. Basically, if you want to take any interpretation from this, take that these have been completely unreliable numbers. And other people saying, we haven't yet seen the proof. And Tom, that raises questions about whether some of these million print expectations are perhaps ahead of themselves.
4,020 on SPX remain. I'm looking at a 5,000 watch on SPX. What's the effervescence linking the job economy, Romaine, to the market?
Well, I think it's going to be more about the participation rate. I mean, we're getting a lot caught up in some of these weekly numbers, which I think are providing a little bit of a false narrative here. Even the monthly numbers, when we talk about that headline number on the payrolls number, important, no doubt, but it's more about how many people are coming back into the labor force. There's a huge sort of undercounted population out there that's not in this labor force. That's been a drag on the economy. It's been a drag on spending. Getting those people back in, that's going to do a lot more for corporate profits and a lot of these other things.
But Tom, and this is what I'm struggling with here, is that we're just now getting the acceleration of vaccines, just now starting to see the increase in mobility. It wasn't necessarily there so much last month. I mean, yes, more than in February, but that to me, Tom, honestly, is a question of whether we actually saw the reopening sufficient with some of the job gains that people are expecting.
It is the impatience that is out there, and national impatience right now to get going, get going, get going. And the but is there, and we have to see how that works through April and May. Let's do this. Let's regroup here. We're going to come up on Jobs Day. It is in 1 hour. We'll go beneath the headline data at 8:30. We've got wonderful, good conversation on this job economy and, of course, how it links into the markets as well. We need to recapitulate the equity markets closed on this Good Friday. The bond market open for trading. I don't know. Do we have Romaine? Are we?
Do we have another board? Because
it's literally like 0.0000000. Fascinating.
Yeah, I guess bonds are trading 168 on the 10-year.
What's the rupiah doing?
Jim Glassman with us, Ellen Zettner with us, with Morgan Stanley as well. Stay with us. This Jobs Day. This is Bloomberg.
minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
Tell us something you're doing that doesn't work out, where you've failed or something you can say you're not good at.
Let me tell you something. There is plenty that I am not good at and plenty that I failed at, but I'm not afraid to fail.
Bloomberg Surveillance. Good morning, everyone, on Jobs Day. Jonathan Farrow, Lisa Bramwitz, and Tom Key. Mr. Farrow, off. We're thrilled that Romaine Bostick is with us as well. Futures up 11, Dow Futures up 52. There is some bond market activity, not showing me all that much right now. And, of course, we go to 8:30 and that jobs report. We've got a running story here. We thank you for listening at home as well. Had a major issue. I just got a call from CAA out in L.A., and they want to be sure that people understand that baby Dominique, as she is known, is represented by CAA. We thank you for sending in that photograph today of the child.
You're just
cherub.
speechless.
I'm
She looks like
speechless.
she's thrilled to be forced to watch us in the morning,
I'm sorry,
I gotta say.
it looks like a police lineup, and we'll leave it at that. Before we get to Ms. Zentner to really kick off our before we get to Ellen Zentner and kick off our Jobs Day, Romaine, I want to go to you because this is where we do individual stocks.
Yes.
Forget about it.
Yeah.
You and I know the efficacy of the VIX. The VIX right now is getting nearish that 13 level. Is the zeitgeist on the strength of the VIX normalizes back to where it was a year or two ago?
I think that's what everyone's hoping for. And remember, there was a lot of angst, a lot of agita over the past few weeks because people really weren't seeing that VIX drop. And there was some concern here that as you had stocks continuing to hit these new highs or get back close to those highs, you still had the VIX rising. There's a lot of volatility under the surface that's not really baked into what you're seeing in the VIX here. But the fact that this week we finally saw it drop not only back down below 18, down to those 17 levels, but more importantly, back down to those pre-pandemic levels, which is what a lot of people really wanted to see, and they wanted a little bit more confirmation that once that gets tamped down, once those volatility expectations tamp down a little bit, that provides a little bit more smoother sailing for whatever the next leg of this market cycle
really
might be.
Important comment here, folks. Dean Kern at Macro Risk Advisors has been wonderful on this to finally see that drop down. And Lisa, it goes with the boom economy and maybe the leggedness, the length, which is the huge mystery right now, isn't it?
Yeah, it also comes at a time when people are really trying to get exposure to risk, where there is, though, that churn under the market. The idea here that there is sort of a natural correction happening underneath the surface. The idea, actually, Bank of America did research showing that if you take a look at the volatility in some of these specific sectors of the S&P, it's as volatile as it was at some of the most difficult periods in 2020. I thought that was interesting.
It's really interesting to see. Well, every firm is different. Every shop is
Romaine's
different.
laughing at me.
I'm just laughing because I'm looking at the boards here that we have around the studio. Everything's unchanged. You got S&P futures. I mean, you can trade that if you're like a degenerate gambler. Bonds are going to start trading soon. 30 minutes here. Am I doing your? Can I just do your data check? This is where I normally show up for like 2 minutes. Somehow I got roped into doing 4 hours. So here we go, folks. S&P futures 4,021. That's what you're looking at on your 1677 on the 10-year dollar spot index. well, you're not really getting much there. But you know what's trading today, Tom? Bitcoin. You want to play the jobs report? Go into BitDog there, 59,498.
Seriously, how do you play the jobs report with the Bitcoin? With BitDog?
Actually rounded up.
I don't know. Somebody's doing it. I guarantee you that.
Okay, let's get organized again here on a jobs day. This is really important. There are ways that every house has a character to their economics. The modern Morgan Stanley economics was founded on Stephen Roach, who had a revolutionary idea decades ago. He says, we're all not on the same page. It sounds like no big deal right now, but I can tell you 20 years ago, this was a huge and original idea. Ellen Zentner is not on the same page as Mike Wilson. We know that at Morgan Stanley. Ellen, tell us about the dialogue at Morgan Stanley between economics and strategists right now. What's the nuance in your debate?
So I know oftentimes, what you point out is right? Economists and strategists tend to butt heads. We tend to look at the world differently. But one thing that we really gelled on since last year, and as you know, we were the only house out there really calling for that sharp recovery.
Yep.
Inflation was going to be higher and become a concern. That is something that we have been very closely aligned with in our views. But fundamentally, I think a lot of houses, have this element where strategists are from Mars and economists are from Venus, because the way we look at the business cycle is just different overall.
Where is the business cycle right now, and can you extrapolate out the enthusiasms of the equity market in your economics?
Yeah, so actually we can. One thing that, again, we are aligned on is that this could be a shorter but hotter cycle. This is something that Bloomberg has been very good about highlighting, a 62-page report that we put out on this to think about.
Yeah, Romaine read it, I didn't.
Yeah, great, Romaine. It's good weekend reading when you've got a long weekend.
It is.
But just to recognize that elements like the extreme amount of fiscal support and monetary policy support and labor costs that have already troughed at a higher level, and the fact that this may not be a new cycle, but a continuation of the last cycle. A lot of these elements tell us that this is probably going to be a shorter cycle than the last several cycles. So I wouldn't think of this in the 10-year view, let's say, something more 5-year view.
So is the idea here that a hotter cycle forces the Fed's hand to hike rates sooner and ends the cycle more quickly? Is that the ultimate bet behind this call?
Yeah, because ultimately, we always like to say the Fed ends business cycles, but it's really the Fed's response to overheating. You look for bad behavior in the economy and the Fed having to respond to that. And so part of this is the promise to keep rates unchanged for years and the intent to reach that maximum employment level that allows markets to overreach for quite some time, where you get inflation that's not just moderately above the Fed's goal, but something that goes even beyond that sort of implicit ceiling of theirs of 2.5%, something that starts to get really uncomfortable. Maybe you have some financial stability concerns in there as well. And so it's sort of, I think it's more than food for thought. I think it is a real risk, but we're just highlighting as something, a way to think about this cycle. Don't think about this as we're just now emerging into a brand new, very fresh cycle where there's a lot of deleveraging going on. We never quite hit the reset button.
Yeah. Ellen, let's bring a kumbaya moment between markets and economists. There's a question about who gets hit hardest when we have a downturn in markets. And again, it's been the lowest wage workers that have been left behind, that have had the bigger downturns and that have not seen as much in ways of participation on the upside. Are we going to see that again? Or are some of these fiscal spending plans going to change this dynamic and create a more core base for some of the middle income and lower income individuals in the United States?
Yeah, well, so I think that we are on the right track, let's say. Income inequality is not something that we're going to be able to solve overnight, but we are on the right track. So what have we done so far? We've given them the kind of support that households need in order to keep them afloat while we get the labor market growing again, while we get out from under this thick cloud of COVID. There are other policies that the administration could be considering. Minimum wage, something like gradually increasing it to $15 over time, which I know has taken a backseat to infrastructure, but that's something that could raise, up to 12% of people out of poverty immediately. I like what we're seeing now, an administration that's transitioning away from emergency support to more sustainable policies that increase productivity, which would allow nominal wages to rise further, and a Fed that is focused on that maximum employment mandate. And so again, this wasn't just Fed and fiscal working together through emergency. Yeah. This is something that's been woven into the fabric of the institutional response that we will see going forward of all levels of government aiming toward more equitable growth in the economy. And I think some of these policies in the Biden administration's plan proposed that we think will go into a reconciliation bill later this year, I think have elements of further tackling inequality. And
then when we talk about the shortening of the cycle and potentially the Fed shortening that cycle here, that sort of circles us back to the boogeyman of inflation, and kind of makes sense of this for me here. We had these structural issues prior to the COVID crisis that had sort of kept inflation in check. Why am I to believe now that those structural forces aren't going to be able to do it post-pandemic?
Yeah, so Romaine, it's a great point. There are very strong arguments on both sides of this. Both sides. We've not seen inflation. Why would we see it now? Or inflation is finally going to emerge. I would point to some of the longer run structural forces that we think will be at play here. So things like globalization, whether it's just slowed or whether you want to call it reversing somewhat, that was something that's been pushing downward on inflation for decades. That we think will be slowly transitioning away from that. I think that process has already kicked off. If you think about demographics, the aging out of the baby boomers after the 1990s away from their prime earning years and working years and spending years into their saving years, that has been putting a downward pressure on inflation. That has reversed. In 2019, millennials overcame the baby boomers, and now you've got Gen Z behind them. It's our largest demographic bubble ever. And they're moving further into their prime earning years and prime working years. That gives an uplift in inflation. Think about regulatory environment as well. Things like minimum wage helps lift people out of poverty, but according to the CBO, it is inflationary. So, fiscal policy activism overall tends to be more inflationary. So I would think about some of those longer run structural forces and just say, let's not be so complacent that just because inflation has been low in the past, that it will continue to be low in going forward.
Ms. Zentner, did you just call me ancient? Is that the analysis that I just heard there?
No, Tom. But I'm telling you, one thing that will be in talk is, of course, and let's be fair, right? I'm a child of the 70s. Okay,
we are.
And so
Ellen's trying to keep a straight face.
I don't like to call myself ancient, but we're not all spring chickens here. Maybe Romaine. Let's call Lisa and Romaine.
She's digging such a hole here.
Tom a few minutes ago was talking about Jack Morris and the split finger pitch here. So
Gorman watches this every morning. She's digging such a hole for herself.
She's not. How is she supposed to respond to that?
Thank you so much. Our
thanks, guys.
At this moment, Chief U.S. Economist at Morgan Stanley, Ellen Zentner, with us today on the demographics of the moment. Lisa, we mention it here, and it's amazing to me, the boom economy. Who wins in a boom economy? The answer is we don't know.
Well, consistently, actually, the older individuals have done better. I just want to throw that out there. They have more holdings. They own homes.
Yeah. They don't call them boomers for nothing.
Tuition.
He's speechless yet again.
Tuition.
It's not the mute button.
Tuition. Futures up 12. Dow futures up 57. Any blocker Invesco next.
Yeah. The U.S. government is out with the March jobs report at 8:30 New York time, and economists are expecting a strong one. According to the Bloomberg survey, they're forecasting that 650,000 jobs were added last month. That would be the biggest increase since October. OPEC and its allies have expressed growing confidence in the global economic recovery. They agreed to increase oil production gradually in the coming months. The group will add about 2 million barrels a day from May to July. The big oil producers are now convinced that fuel demand is on firmer footing. And there will be a semiconductor summit next month. White House economic and national security advisors will meet with chip makers and auto companies to discuss the global shortage of microprocessors. The Biden administration is reviewing supply chains for chips and other products. A top White House aide will lay out U.S. strategy toward North Korea and Kim Jong-un today. National Security Advisor Jake Sullivan will be meeting with his counterparts from Japan and South Korea at the Naval Academy. President Biden has warned the U.S. will respond if Kim escalates recent missile tests. In China, regulators plan to impose additional capital requirements on the country's too-big-to-fail banks. Systemically important banks will be put into 5 categories and face a surcharge of up to 1.5% on top of mandatory capital ratios. Lenders will also need to make detailed plans on how to recover from a crisis. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Abramowitz, and this is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
Well, everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
Ultimately, it's billions of dollars from the government that will pull that vaccine through and purchase it for Americans and people in low-income countries.
Explores how a chip shortage snarled everything from phones to cars on a Bloomberg television special, Chip Crunch, Wednesday on Bloomberg Technology.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? combustion engines get electrified.
The stocks to bond correlation, it flipped positive in 64. It stayed positive until 1998 or so. So the last 20 years have been a negative correlation regime, and our whole 60-40 world has been built on that basically. But for decades before, bonds really did not diversify against stocks. During the 60s and 70s, it was cash that was your main diversifier, not bonds. So it's a big potential structural shift that we really need to look at.
All right, you're in Timmer there, Fidelity Director of Global Macros. That was part of a roundtable discussion we had with him and Barry Knapp over at Ironsides. That's going to air on Wall Street Week, one of the many shows that I host on this very fine network here, Tom Keene. I make time for Bloomberg Markets Close, Wall Street Week, and now right here at Bloomberg Surveillance.
You're literally working a 4-hour day. It's great. Romaine Bostic with us this morning, folks. Jonathan Farrell on a cute. How long is Farrell off for, Lisa? Is it 2 or 3 weeks?
A month.
Wow. It's a month.
Yeah.
It's like a sabbatical.
Yeah,
Seriously.
another sabbatical. No, he'll be back next week. He'll be back next Thursday.
He's not leaving the country, is he?
No, he went to Capri. I think seriously. Good morning, Alitalia Airlines, and I think he's starting in Capri, but it's like the Peace Corps. He's off for a month or whatever. We welcome you on Jobs Day. Romaine Bostic, we're thrilled to sitting in on this Good Friday. Lisa Bramowitz, Tom Keene, and to give you the lay of the land here at 45 minutes, this important jobs report, really anticipated to be the liftoff. It is a liftoff for all. Before we digress to the works of Washington, we must note right now an historic landmark across this nation. And that is that the Red Sox are ahead of the dreaded New York Yankees. The Red Sox have yet to play here on opening day. They play this afternoon against the Yankees down in flames yesterday against the Blue Jays. Andy Blocker of Invesco noting this, that the Yankees are behind the Red Sox, his beloved Yankees there. I mean, Andy, it really says to the spirit of opening day that in terms of the stimulus of this country, in terms of the amount of money that's going to get pushed to the economy, for President Biden, it literally is opening day.
Yeah, I think you're right. I mean, look, we just had the COVID-19 relief package. It's $1.9 trillion, but most importantly, it's $1 trillion expected to be spent by October 1. And that's an incredible economy. So there you go.
That's really good. The timeline here is very involved. As head of U.S. government affairs for Invesco, lay out the timeline of $2.3 billion. It's not $150 billion a year over 15 years, is it?
No, this is a much slower spend. So, like the COVID-19 relief package is a booster shot. This is more like of a long-term, taking your vitamins every day, kind of catching up the U.S. to where the rest of the world has been. We're 13th in infrastructure. And we need to make up some ground. I think earlier on your show, you're talking about it's over 8-year period. That comes out to $280 billion a year. So this is about maintaining job creation over the long term, kind of changing the mix of the job creation, more green jobs, et cetera. So that's the way I look at it.
This also seems about really kind of nudging the private sector also to boost their capital spending as well. We focus on the government spending side of this, but how much of what's baked into this program is intended and can potentially sort of get those companies to start spending that money?
So that's a great point, Romaine. I think that the key there is that you have the public-private partnerships that are going to be in there, but I think more it's about as the U.S. government invests, the private sector will invest alongside of it, and there'll be look, there's going to be, I think you guys were talking earlier about China and semiconductors and things like that. There's going to be a lot of seed money that the government's going to help with the private sector.
It's no secret out there that, at least behind the scenes, Republicans probably support most of these programs just as much as Democrats do. Where they differ is much more on how you pay for these programs here. What's the selling point here that maybe gets some of those Republicans on board with at least some of the tax hike proposals?
Well, I think it's going to have to be very targeted on the tax proposals. I think once you get to the individual side, which hasn't been announced yet, which will be announced, there'll definitely be some individual side. But right now on the corporate side, I think on the corporate rate increase, I think, look, they're not going to go with the 28%, going back up to 28%, but there's some who may go up to 25%. And there's some who are going to have some targeted tax things that they'll go with. But really it's hard for Republicans to sign on to any tax relief unless they can tie it to something that they can say, hey, here's the good that I'm doing for the country. Maybe a few House members, but in the Senate, it's really, really tough right now.
Andy, do you think that this actually is going to get done as a $2.25 trillion deal?
Actually, I think unlike the COVID-19 relief package, which was pretty much set, 1.9 trillion, and a few things changed and they got it through, this is just a proposal. And I think they want to be in that magnitude, that level, but they may have to break it up if they want to get that. If they want to do some of it bipartisan, they're going to have to break it up. They're going to have to do the physical infrastructure. That's going to have to be less than $1 trillion with limited taxes associated with it. And then you can do more on the other side of that to bring the number up. But they just want to get it done. They don't really care how it gets done. Biden's been very clear about that. This is going to be a tough, long slog.
So I'm going to ask this on behalf of Paul Sweeney and all the residents in New Jersey, as well as New York and beyond. There's a question of whether the moderate Democrats are going to push Biden to remove the caps on the SALT tax deduction, the state and local tax deductions, as part of this plan. What's your view on that?
Oh, absolutely. I mean, I'm originally from Jersey, so Jersey's strong there.
And you're a Yankees fan?
And I'm from Jersey. Yeah, exactly. That's what we do. But anyway, but my thing is that my good friend Representative Gottheimer, I mean, he came out strong day one, said no SALT, no dice. I mean, SALT is key. And you have Schumer is the majority leader. He's going to want to push this. I think SALT is going to be in play here. The problem with SALT, though, is it costs money to restore it.
In what way? Explain that.
So if you right now they've capped it so you can only do I think 10,000 of your local state tax to come away from your federal tax obligation. The further they raise that up, the more expensive it gets. And if they restore it to where it was before, I think it's up to $600 billion. And if you do that, that means you're going to raise $600 billion more somewhere else.
You know, Andy, this is really great. I love the home run that Sanchez had yesterday for the Yankees. Is Sanchez of the Yankees the most underrated catcher in baseball? I've always thought he was.
Yeah, so there's mixed views on Sanchez. I'm going to stick with him. I think when he's great, he's great. When he's not, he's not.
Fair.
So it's early in the year. Look, I'm going to give you your day in the sun as a Red Sox fan. Like in April, you can win the World Series.
See, the difference here, folks, and you got to understand this, for our global audience, the Yankees are 0-1 and they're thinking World Series. When the Red Sox are 0-1, the season is over. That's the difference. Mr. Blocker, thank you so much. With Invesco, head of U.S. Government Affairs as well. I mean, Romaine, is painful here, and it's really Calvinist. It's like, May 1st, the season's over.
Well, okay. Well, at least we're 2 hours into the show and we haven't talked soccer at all.
Well, I will say this. The Mets, even worse. They couldn't even play their first game, so I'll give you that. Honestly, they don't even have a score, which pretty much sums up the Mets.
Actually, the Tots play. I'm glad you brought it up, Romaine. The Tots play this weekend. And, we're looking for Tottenham to do some good things this weekend.
Romaine, are you proud of yourself?
Yeah, I'm proud of myself. I'm a big soccer fan.
Futures up 12, Dow futures up 64. Romaine Bostic and I looking at a VIX of 17.33, and that is a bull market. That'll be our theme with Savita Subramanian, Bank of America Securities. Subramanian on stock, Subramanian on where is ESG right now. It's Jobs Day. Stay with us.
That Norway sells way more electric cars per capita than the U.S.? Norway.
Well, I won't stand for it.
In this neighborhood just outside Oslo,
The majority of cars are electric. Last year, Norway became the first country in the world to sell more electric cars than any other. In December, EV market share was at 67%. In 2025, the country wants all cars sold to be zero emission.
Hey, Norway, listen up, you fish-loving... Oh, this place is adorable. Damn it.
But why is Norway leading this development? The country is rocky, it's ice cold, and with huge distances. The easy answer is politics. By giving the consumers benefits that pay off, more people will go electric when they're getting a new car. These perks could be no VAT when buying the car, reduced tolls, the possibility to drive in the bus lane, and quite a bit of free parking as well. 2021 is an election year in Norway, and the Climate and Environment Minister Sveinung Rotevatn believe the EV perks will be a hot topic in the campaigns, where removal of the perks is set to be a central issue.
Madame Lagarde, has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly playing out at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim, we're going to be riveted to that, and we're going to do what is required.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
A strong year. We're going to see some really strong job numbers.
We're actually in the period right now where the global economy is starting to accelerate.
There really are some limitations as you grow at speeds that you haven't seen in more than a generation.
We're going to see the strongest economic growth in 50 years.
If the market's pricing in a Fed hike in early 2023, it's pricing in the continuation of growth.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, Bloomberg Surveillance. On this Passover, within this Good Friday, we say good morning to all of you. Romaine Bostic in for John Farrow on this important jobs day. Yes, the markets are closed. The equity market's closed. Bond market is open and trading to give information and market response to jobs day, but a very different Good Friday for us, and we're thrilled that you join us across this nation and worldwide. Savita Subramanian to join us here in a moment. Jim Glassman with a pulse of our labor economy here in a bit. And Lisa Abramowitz, it is the most interesting time, and as Tom Porcelli said, the most unusual labor economy and March jobs report, because we're on the cusp of a boom economy.
Yeah, the shocking shutdown and then the unbelievable recovery that people know they can't quite get their arms around. Just to give you a sense of the range here, 232,000 is the low estimate, 1.1 million the high estimate. People are throwing darts at a board to try to understand, Tom, just how robust this recovery is going to be.
On Bloomberg Radio, on Bloomberg Television, you know, futures up 13, Dow futures up 64. And the correlation here, Romaine Bostic, of equity markets and a bull market, S&P 4,023. I mean, Romaine, how correlated is your world of the equity markets with this economy?
Well, I mean, I think the market, as always, is usually out in front here. I mean, obviously, they're sort of betting on that future growth. I mean, look, if you start to see those 1 million type of prints that some people are anticipating, then maybe that justifies where we're at 660 or anything below 660. It certainly calls into question the pace of the economic recovery and, more importantly, the pace of the restoration of all those jobs lost during the pandemic.
Romaine, opening day of baseball, we're focused on that. In 2 weeks, April 14th, we get J.P. Morgan earnings. Some would say the beginning of an earnings season. How does the earnings season frame up, Romaine?
Well, it's going to be better than the last one. I mean, everyone's expecting an increase in corporate profitability. They're expecting that to continue not only here deeper into 2021, but also into 2022 at a pace that some people say will justify some of those valuations that we see. But it's going to be a bifurcation, as you say, between some of the large cap names out there and some of those smaller cap cyclical names that have been bid up here over the past couple of months.
Lisa, I look at Jobs Day, and I look, we're going to talk to a lot of people here about it. And we make jokes about the gloom in that, but I'm almost worried, Lisa, about the effervescence, the certitude of 8 or 9, some people even 10% GDP as well. Where's your radar up on this, Lisa?
I love that Romaine is laughing because basically you're trying to tweak me as being Miss Gloom over here and see if I can bring some sort of gloom to these effervescent forecasts. I think that the bigger question is not only how big is the GDP number going to be now, but does that indicate a slower end cycle? The idea here being that we've got a faster crash and then returning to a new normal that is yet even lower in terms of growth and in terms of inflation than before. And that is the gloom narrative here.
Yes, it is.
And I think that the other gloom narrative, and this is actually really important as we talk about inflation, is that the prices of things are going up. And we're going to be hearing in these earnings supply chain disruptions and food prices and all sorts of basic input costs going up, whether they can pass those on to the consumers. Yes,
I wasn't talking about the economy. I was talking about the New York Mets is the pendulum of gloom.
Yes, it is.
I mean, they're doing well. Like the Red Sox, they haven't played yet, which I guess is a good and
positive,
constructive thing. Let's look at the data right now. Futures up 13, Dow futures up 63. Markets not trading. What's the wow there, Romaine? Why do you say wow?
Effervescent. Every time you say that, I'm going to take a drink here. Wow, because really, there's not a whole lot of trading activity going on. You're going to see a little bit of pop here, probably in the Treasury market in about 30 minutes or so when we do get that jobs report number, particularly if you get a surprise here. But really, there's not much else you're going to move for. You can go into S&P futures, you can go into Bitcoin if you want, and obviously a little bit of activity there going on in those fiat currencies.
I'm going to look at gold, 1728. And again, folks, we would mention the DXY, that blended major trading index at a 93. Let us get started. Again, Jim Glassman on the labor economy here in a bit. But right now, Savita Subramanian of Bank of America, head of U.S. equity and quantitative strategy, to frame out here the belief forward. Savita, dovetail a boom economy into the B of A call on the equity markets.
Yeah, I mean, I think that the bottom line is that the S&P is not the U.S. economy. And in fact, we've seen that over the last few years. I mean, last year we saw the market hit all, new highs, despite the fact that we were in one of the worst recessions ever. So I guess our call is, the economy is going to be great. It's hard to say that we're not going to see something above, with a close to 7% handle on U.S. GDP growth, but the multiple expansion that we saw last year is essentially anticipating that. So I think this year is going to be more about earnings growth with actually some pretty significant multiple compression. And just dovetailing on Lisa's comments about inflation, I don't think that we're going to get through this year without some inflation shocks. And I think that's what could cause some of the multiple compression. So it's going to be trickier from here. And the one thing that we pay a lot of attention to, and I know, I've talked about this on your show, is just the various sentiment measures that we track. And sentiment right now is very, very bullish, which is a contrarian sell signal on stocks. We've seen asset allocators ramp up their allocation to stocks to close to, levels that we saw only back in 2007. And as you know, 2007 was a year where you did not want to be buying equities. So you saw the market go down over the next couple of years. So I think that we're at a point where, everybody knows we're in a bull market for stocks. The S&P 500 is the index of choice. And, now it just gets tougher for the market to continue to hit new highs.
All right, Savita, build on this. I mean, harder to hit new highs, but does this mean that we're setting up in a 2007-like environment where we're going to just simply set ourselves up for a big fall with markets predicting the end of this cycle?
Yeah, I don't think we're necessarily in for a kind of a bear market, but I do think that it's hard to imagine a major rotation from growth to value, from disinflation beneficiaries to inflation beneficiaries without a little bit more volatility and some downside risk. So, our year-end target, which sounds really bearish right now, is 3,800. And that's really assuming that we get this rotation, we see leadership in cyclicals and smaller companies and, GDP-sensitive CapEx beneficiaries, but we don't necessarily continue to see the S&P 500 crush it. I mean, think about it. The S&P is not a good proxy for the economy. This has been the best performing benchmark over the last 10 years, despite a really lackluster economic cycle. So that's really our call.
Yeah, it may not necessarily be the best proxy for the economy, certainly a proxy on market sentiment. When you talk about those valuations, Savita, and you talk about how much of, I guess, maybe that future growth is being priced in today here, is there still a possibility we still continue to get gains here? Obviously, though, at a much sort of lower pace. So basically avoiding a true bear market, avoiding even any sort of severe correction. What are the ratios? What are sort of the multiples now telling us about that future?
Yeah, it's a great question. So I think multiples right now are telling us that we're in for kind of lower but still positive returns over the long term. So interestingly, what we found is that PE ratios or, valuation isn't a great short-term predictor, but PE ratios can explain almost, 80% of what happens over the next 10 years. And right now, what the market's multiple is telling us is that we're going to see something around, low single-digit returns for the next 10 years. So I totally buy into that. I think you're right. We're going to see, sort of a lower return environment, still positive returns. You still want to be in equities rather than bonds as we see rates, potentially continue to rise. But yeah, we're done with the sort of double-digit amazing heyday for stocks that we've seen over the last decade.
What have you learned in the last 12 months about ESG? Savita, you have led the Bank of America effort on ESG and all of it. There's some critics of those that are pro. What have you learned academically about the efficacy of ESG?
Yeah, Tom, thanks for the question. I mean, I think that ESG investing has legs. It's not just a fad. And, furthermore, it's not a new theme. We've all been thinking about ESG risks since day one of investing. But I think what's happening today is that these risks and these attributes are being codified into the equity investment process. So, you and I have talked about this. I think ESG is not just, exclude tobacco stocks, exclude this whole broad swath of the market, but it's really more about thinking about the specific risks of a company when it comes to how they're managing their environmental, social, and governance risks.
Savita, thank you so much for joining us. Savita Subramanian, Bank of America, head of U.S. Equity and Quantitative Strategy. On this job day, we migrate 20 minutes in, and we welcome all of you across this nation and, of course, around the world. Thrilled from Cambridge in England. Lisa, Dr. El-Arian emails in, and he just makes clear with the dreaded New York Mets, Steve Cohen signing Lindor, the shortstop, for $341 million large.
Yeah.
I don't think that's per year, but that's a lot of money.
No, it's a 10-year deal. This is a 10-year deal.
Yeah, El-Arian, wants, he wants Francisco Lindor money. That's all there is to it.
We can discuss his contract negotiations at another time. I will say, as a Mets fan, it's very hard to hear anyone even mention them on air, and I assume that it immediately raises this sort of sympathy, empathy, longing.
He's a lowly academic. Cambridge, they're just not popping the Mets money this year. Futures up 12, Dow futures up 51. Romain, into this jobs report, what's your observation on the oddity of equities close today?
The oddity of equities close is basically it doesn't matter, Tom. I mean, the market pretty much priced this in over the past 3 days, at least their anticipation. What matters here is if we come really far off that 660 estimate that people are looking for. You come in too hot or you come in too cold off of that, that's when you could see some carnage on Monday, depending. But right now, it looks like we're going to have to keep an eye on the bond market for that.
We are here for you on this jobs day. And
they are trading. We started that. Did we signpost that? Did we do that on the show?
Yeah, Abramowitz may help us with the bond
She may.
market.
We'll see.
Here, futures up 12, down futures
Let's see if
up
she's
53.
in contract
I
negotiations.
can't get a word in here
All right,
edgewise.
2 hours
Just
and
have
11 minutes in,
silence as we
folks.
go to break.
2 more hours to go.
It's gorgeous.
With the First Word News, I'm Rishika Gupta. Talks on reviving the nuclear deal with Iran will resume next week in Vienna. At a virtual meeting today, Iran and the rest of the world powers still in agreement discussed a possible U.S. return. Amongst those taking part, the EU, China and Russia. Iran's insisted that the U.S. must drop sanctions as the first step. There'll be a semiconductor summit next month. White House economic and national security advisors will meet with chip makers and auto companies to discuss the global shortage of microprocessors. The Biden administration is reviewing supply chains for chips and other products. In Taiwan, the deadliest train accident in decades. At least 48 people were killed when the train derailed at a tunnel on Taiwan's eastern coast. Railway authorities say the train collided with an unmanned vehicle that had rolled down a hill. More problems for AstraZeneca's coronavirus vaccine. The British government says there have been 25 new reports of blood clots linked to the shot. That adds to the numbers that caused European countries to impose restrictions on that vaccine. Pioneer Natural Resources is expanding in the Permian Basin. It's agreed to buy Double Point Energy in a deal valued at $6.4 billion in cash and stock. It's one of the biggest American oil takeovers this year, and it comes less than 3 months after Pioneer bought fellow shale driller Parsley Energy. And it's a match made in tabloid heaven. The South Korean company that launched K-pop sensations BTS is buying the U.S. media group behind the careers of Justin Bieber and Ariana Grande. Big Hit Entertainment is spending a little more than $1 billion to acquire Ithaca Holdings, the parent of Atlas Music Publishing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability have our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I like what we're seeing now, an administration that's transitioning away from emergency support to more sustainable policies that increase productivity, which would allow nominal wages to rise further, and a Fed that is focused on that maximum employment mandate. And so again, this wasn't just Fed and fiscal working together through emergency.
And as she does, Ellen Zentner absolutely nails the mystery, not for this March jobs day, but maybe a year out and maybe 2 years out. We welcome all of you. Good morning this jobs day. Lisa Bramwitz and Tom Keene, Romaine Bostic in for John Farrow. We're thrilled that he could do that. We're 15 minutes away as well here. And just because of the importance of this conversation, guys, I really want to get right to it with James Glassman of JP Morgan Chase Commercial Banking, who has decades of experience of just really looking at these dynamics, and particularly the wage dynamics. Jim Glassman, when do wages go up?
Well, I'll tell you, I think the key actually to the real wage growth that matters, is getting faster productivity growth, getting people into better skills, get the skills to people so they can get better paying jobs. That's the key, because we're living in an era of lower inflation, lower nominal everything, and when that happens, nominal wages don't do much. We would tell you, most economists would tell you, 3% wage growth is sort of what you expect in this environment. And I think the key really isn't so much the macro environment as getting people skilled up. There's just an awful lot of new opportunities. And that's what you need.
Well, Alan Greenspan, Ed Hyman, and Jim Glassman are on the same page, which is look at the actual data from sea to shining sea. Jim Glassman, what do you see in your contacts with JP Morgan Chase?
Right now, everybody is, they had been hopeful for most of the last year, actually. Most of the folks that we talked to, they knew what this is about. It's a medical crisis. It had an answer. And they were looking to the day when we would sort of start getting back on our feet. And they're feeling pretty comfortable about that. The problem is a lot of them are still struggling with, there's a lot of bottlenecks in the supply chain because of everybody was so cautious last year that's what we're dealing with. I saw the first hint of hope yesterday, though, when you saw, there's a chip shortage that's causing a problem for the auto industry. Well, yesterday we saw a surge in car sales, and it tells me that, yeah, we are probably starting to wake up. And this is the kind of news that people have been hoping for, waiting for. We economists keep telling them we're going to get back there. Maybe by the end of this year, hopefully, maybe goes into next spring. They're all pretty much on board. But, of course, I'm not talking to the guys who've been struggling, the restaurant owners who had to bail out. That's going to be a little bit of a work, getting all them back and getting people reskilled. In New York and L.A., they got to do a lot of training, bringing new people in, because a lot of the guys that used to work in hospitality that moved somewhere else because they couldn't survive a year with no pay.
Well, and that's exactly where I wanted to go, scarring, the idea of longer lasting shift due to some of the tech changes as well as the pandemic. Do you think that fears of scarring have been overblown, or perhaps are not being played up enough right now, Jim?
No, I think they've been overblown, because when you think about it, the sector of the economy that is struggling the most is the hospitality sector. The waiters, the people working in the fitness centers, those skills, they don't disappear. Once you learn how to do that, that's not something that requires years of training. So I have a feeling the scarring idea is going to be short-lived. The minute we start opening up communities, let people go back to restaurants, which is happening now, you'll see a lot of those jobs coming back in.
So do you think that we're going to see a longer cycle than perhaps some people are expecting, people who expect us to return to the new normal of low growth and low inflation in 2 years?
I hope so. I mean, I really think I really think that the Fed's views have got the right idea. We get back to 3.5%, 4% unemployment. This is not a cycle that we're in. This is a natural disaster shock. And once we get back there, then I think we'll be back to thinking about what does this cycle look like. I don't really know how to think about it because everybody was thinking that, a year ago they were thinking, gee, we're sort of long in the tooth here. How long can this last? I really think the shock here has bought us more years. We're going to have a longer period. And if the policymakers can do things to enhance our underlying productivity growth, underlying long-term growth, that there's no reason to be thinking that the cycle is coming to an end anytime soon. So I think it's way too early to worry about the end of the next cycle.
So if that shock has brought us more years, have they brought us, I guess, better years? The last economic cycle, and more importantly, coming out of the global financial crisis, one of the big drawbacks here was you had job creation, but it was job creation at the lower end of the wage spectrum. There's concern that that is essentially what is happening again this time around, Jim.
Yeah, that's been a challenge for a couple of decades, really, because there's a lot going on innovation, and it's disrupting a lot of industries, and a lot of jobs are disappearing. And there are a lot of new job opportunities, but it takes skills and training to get you there. So I really think the shock is doing something good for us because it's exposing things we could do better, like what happened a decade ago.
Jim Glasson, we're having a wonderful zeitgeist this Good Friday Jobs Day. It's a very different Jobs Day, and Dr. Alarian is out on Twitter, and Mohammed Alarian is talking about the great distinction of an economic recovery. Do you perceive a jobless recovery benefiting the haves, or do you actually see true job formation after the pandemic repair?
I think we're going to see true job formation and better job formation. I mean, you want people into jobs that can take advantage of all this technology and innovation. A lot of folks have been benefiting from that, but there's a lot of folks who aren't prepared. They don't have the skills for that, and I think everybody's aware that that's our real problem. We have 7 million jobs businesses say they cannot fill, and that tells me there's a lot of opportunity out there. And I think increasing the business community, the public sector is thinking more, what do we do to get money into programs that help people get the skills? And it's happening at a local level, community colleges, business community. But it could use more help from the public sector, too.
James Glassman, thank you so much. Jim Glassman with us on Jobs Day, a great tradition here with Ellen Zentner and the others. Romaine Bostic, I look at this and it really comes down to the mood, the confidence of C-class officers. What do you see?
Well, they're confident here, not only in the economic recovery, but I guess more importantly, on their own power, I guess, with regards to keeping their costs down and keeping their pricing power up. That's called margin. And right now they feel like they have that margin working in their favor here. I guess the question here is that when you take a look at the jobs report and you take a look at the anticipation that we could finally, at some point in the future, see some meaningful wage growth, does that begin to sort of erode, I guess, what has been sort of a boon for a lot of these companies?
Lisa, you've been really on this story, and I don't have a strong opinion here, but I just wonder the behavior of companies in terms of the marginal new employment after we heal from the pandemic.
Well, the idea here that you're seeing jobs in the tech sector very much in demand, and you're seeing wages rise, and you're seeing wages rise at the higher end of the wage spectrum. The question is the middle and the lower income, and the question is whether Joe Biden's going to come and push that sort of union type of push to get the wages higher, whether he's going to push minimum wage, or whether it will even work at a time when you've got rising input costs and you have companies that are looking to expand but not increase their costs too much, Tom.
7 million jobs looking at from J.P. Morgan over the coming months. We'll see what this report looks like. Michael McKee is reported to be in the building to give us wisdom as well. Alan Ruskin will join from Deutsche Bank. Wonderful guest to have to synthesize all of this for the American and global economy. Stay with us. It is Jobs Day on radio, on television. This is Bloomberg.
This patch of land in northwest Saudi Arabia is going to become Neom, a city powered entirely by renewable energy. The government hopes the site, which is the size of Belgium, will be a clean energy hub, not only for the kingdom, but also the world.
This here is at the borderline between Mission Impossible and Suicide Mission. Lucky enough, so far we've just been on the right side of the line, yeah. But you know, it's very close to that. You know, this is just smoking. This is nothing ever I've seen or heard of the dimension, the challenge. You know, I'm not talking energy only. You know, but in its broadest context, including the geopolitical dimension, including the cultural dimension.
NEOM will include a $5 billion hydrogen plant run on wind and solar energy. All of the zero carbon fuel it produces will be shipped to international buyers in the form of ammonia. When it starts operating in 4 years' time, it will be one of the biggest hydrogen facilities in the world.
Can't explain NEOM on the back of a set of PowerPoints and a video clip. You just need to be here. You need to, breathe it. And specifically the startup mode and, things happening, buses all around you here.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Bloomberg Surveillance, and we welcome all of you on this Jobs Day. We are 50 seconds, call it, away from an important jobs report. Romaine Bostic in for Jonathan Ferro, Lisa Abramowitz, and Tom Keene. We welcome all of you. A most interesting Good Friday. Michael McKee with us with the data. Michael?
Well, the data is good, not as good as some of the most optimistic analysts would suggest, but total non-farm payroll employment, 916,000 more in March than in February, so we added almost 1 million jobs. The unemployment rate does fall down to the forecast 6% during the month. Taking a look at some of the other data, the one that everybody kind of wants to see is the participation rate. The Fed is focused on that, 61.5 in March. That's little change from where it was before. So no real indication that a lot of people coming back into the labor market at this point. Taking a look at some of the jobs that were created, leisure and hospitality helping lead the way, 280,000 jobs as governors open up states, restaurants and drinking establishments, things like that, start to open up. Nearly 2/3 of that was in food services and drinking places. 176,000, Tom's personal bartender, back at work.
Got that right. Good morning, Michael.
The local government education also rose because schools started opening. 76,000 in local government, 50,000 in state government education. So there's a change, and we're seeing, what one economist called not so much a rebound, but a restart. Construction adding 110,000 jobs during the month, and manufacturing employment rose by 53,000. That is better than the 35,000 that had been forecast.
Michael, let me jump in with market response here. Where the futures were up 12, 13, now up 18 as well. Again, the equity market not open today. And in the yield space, it's a mixed story, but I'm going to say a little bit lower price and higher yield as well. Dollar resilient this morning. Michael, I see the revision is well up nicely. I calculate that at 89,000. We're both working here quickly as well. There was the survey, Michael, but there's a set of pros above that. was this good news within the whisper numbers, or was it genuinely above what was expected?
It was genuinely above what was expected. I checked on the whisper number this morning. It was 800,000 going into the report. So
how come only you get the whisper number?
Because they whisper it. I mean, you got to turn up your hearing aids.
How come it's Bloomberg surveillance on radio and TV? Okay, continue.
All right, so that's the whisper number. The other number that some people have been watching is the alternative unemployment rate, and I don't mean the adding in the discouraged workers. What I mean here is the fact that workers are misclassified, and the Bureau of Labor Statistics says the unemployment rate would be about 4/10 higher if they were all properly classified. So somewhere between 6 and 6.4% is what we're talking about there. In terms of the participation rate, again, 61.5. The hours worked number is interesting because it was 34.6 last month. It jumps to 34.9. That's 0.2 above the forecast, and it suggests that employers aren't adding all the workers they need, that everybody's having to work more hours to keep up with business. So that kind of gives you a sense that we might see a better report for even April.
Now let's reset here. Michael McKee with us, running all of our economic and policy coverage on this jobs day. It is a killer jobs day with futures up 15, now up 21, 4,031. Romaine, I really want to pull you in here right now. I know Lisa's got a great observation on the bond market as well, but Romaine, this is an equity market buying in to a boom economy.
Absolutely buying in. Not everyone is away here. You're seeing a lot of uptick here in those equity futures, particularly on the volume side, something that we didn't really expect, given that it is a Good Friday holiday and the cash market, of course, is closed. At some point, you got to put the 5-year up there, too, because that was where we saw the biggest reaction in the belly. I know you don't, but that's where most of the volume was. That's where most of the trading was, and it's signaling one thing, that 900 print that we got today, that expectation was not necessarily priced into this market. And if this is part of a longer-term trend here, then you're going to see a big repricing when we get back here on Monday.
We don't do the 5 and the 7-year because it's the belly of the yield curve. Lisa, why don't you pick it up on radio? I was just looking down.
He was looking down. Yeah, for all those on radio.
Lisa, please.
A reference to other things other than the belly of the curve. This is on radio as well. Can you believe it?
It works.
Right now, I do want to get a sense, though, of how much better than expected this data actually was. And I want to go to the average hourly earnings, Mike, the idea that they actually declined. This isn't completely against expectations, although the consensus was for an increase of 0.1%. Wages declined by 0.1%. The implication here, more lower wage workers brought back on. Is this good? Is this bad? What's the implication?
It would be good, more lower wage workers coming back on. Obviously, it's not good they're paid lower wages, and there are a lot of efforts politically to try to raise those wages. But yes, we had subtracted a lot of the low-paid workers during the pandemic, and so that pushed average hourly earnings up significantly. That's going to start coming back down now, and probably until we get close to replacing all those 10 million jobs that we were still short, you're not going to be able to look at wages as an accurate gauge of the tightness of the labor market because of the fact that those who get paid less are coming back in. On a year-over-year basis, we went from a 5.2% increase last month to a 4.2 increase, so a full percentage point lost by those people coming back in.
Mike, talk about that participation rate. What do we make of a 61.5% participation rate?
Well, it does show you, because we're still about 2.5% below, or about 2% below where we were when the pandemic started. And it does tend to show you that the people who went back to work kind of knew they had jobs. We didn't attract, we had 347,000 additional people into the labor force. That's not a lot when you consider how many left. And that's a number the Fed's watching because they want to make sure that people who want jobs, they can find jobs, because they're not going to look for jobs. If you were in the restaurant business and you don't think there's any restaurants hiring, you're not going to go look. And they want people back in the labor force looking for work.
Michael McKee with us, and he will continue to analyze this important boom jobs report with futures up 23, Dow futures up 193. What we'd like to do on a jobs day then is synthesize what this means for the global economy and for the different market categories. There is no one better to do this than Alan Ruskin of Deutsche Bank, synthesizing all of David Folkert's Landau and their team's research. And Mr. Ruskin joins us this morning. Alan Ruskin, it is American boom economy. Is America the locomotive to drive the global economy forward?
Tom, I think this is the first and very early stage that suggests that's exactly the case. I think, when the year is all said and done, we'll see the United States economy growing at a more rapid pace than China for the first time in over 40 years, really. So that in and of itself is just one measure of the extent to which the US is going to lead the world as far as global growth is concerned. The big hope, of course, is that this growth is sustainable, that it's non-inflationary, of course. So there's going to be imbalances, but from a global growth standpoint, the US is definitely in the lead.
So could you talk a little bit about what you're looking for to determine just that, how long-lasting this boom can be?
Yeah, well, I think there are a couple of things. I think imbalances inevitably show themselves up in the external balance data, the extent to which supply can actually meet excess demand. So if there are huge imbalances, watch that current account data first and foremost. Then there's the second order question, which is probably even more important, which is whether we see, the inflation pressures, both on the cost push side, but probably more important longer term on the demand side, which would then force the Fed to tighten, and that could truncate the whole cycle. So I think those are the two big elements I'd be looking at.
Another element that people are looking at is the underemployment rate, the number of people also permanently unemployed, much higher now than it was pre-pandemic. Are we ever going to get back to pre-pandemic times? Are we going to go below that? Or are we going to end this era with a higher number of people who are completely out of the labor force?
Well, I think if one's optimistic enough on growth, and DB as a house certainly is, then you could be looking at an unemployment rate below 4% into 2022 and close to 4% by the end of this year, which is truly remarkable considering where we've come from. And one would presume then that you'd see the U6 rate also come down very sharply, maybe not quite to the pre-COVID levels, but pretty close, I think. So underemployment would be reduced substantially.
And Alan, as we look at sort of the price reaction here in the bond market, and the idea here that yields had sort of gotten out a little bit ahead of the data here over the past couple of months here, when you look at 916,000 jobs created a year, was the bond market basically right?
Yeah, I think the bond market was, anticipating a strong number for sure, and the bond market correctly is focusing on all the things that will stir up growth longer term: the fiscal expansion, the money supply at record levels, the pent-up demand, and the vaccine openings. All those elements would be special in their own right. Combined together, they absolutely going to drive this record growth rate that we've been talking about. So the bond market is absolutely right to be ahead of it. Is it completely ahead of it? No, I think yields can still go further than this.
With regards to the recovery, the economic recovery here in the U.S., the recovery going on elsewhere in other parts of the world here, is this going to be a synchronized recovery?
I think it will eventually be a synchronized recovery. And by eventually, I still think that Europe has a lot of catch up to do vis-a-vis the vaccines and then vaccine openings. It's going to lag a little bit because it doesn't have quite the same fiscal and monetary stimulus as the U.S. has. But I think the U.S. is going to tug everyone along for the ride. It's just going to take a little bit of time for the synchronization to kick in. Vis-a-vis Europe, I'd say they're probably lagging by about 3 months. The emerging markets world is a little bit more dependent on China. China's not got its foot flat on the accelerator, so it also will lag a little bit. And there's less pent-up demand there as well, because savings ratios haven't actually gone up and are not going to come down as much. So I think, again, it reinforces the view: U.S. in the lead, Europe to catch up maybe within, 3 months or so.
Alan, I'm looking right now at the 5-year Treasury yield because that's what Romain Bostic pointed out. And he is correct, I will say. The belly of the curve, very much instructive here with the idea there is a lift in yields on the back of this report, better than expected. Alan, when we talk about inflation and you're talking about China and the U.S., it all comes together. Are we in a new inflationary regime given the fact that China has gotten wealthier, that China perhaps is not going to play the same kind of role as it has over the past 30 years, suppressing wages and suppressing input costs around the world?
Yeah, I think it's a hugely interesting question. We've had 25 years really of disinflation emanating, in no small part out of the disinflation-related labor market impetus from China. So I think that does ease up to some extent. But I think there are a lot of different elements. Of course, what we're seeing in this particular cycle is bottleneck pressures all over the world. I've never seen anything quite like the PMI supply and delivery numbers that suggest bottlenecks everywhere, at least as relevant in the European heartland as in the United States. So that cost push pressure is unique. And I think, then you point to, the longer term issues that relate to wage pressures. Perhaps there'll be a little bit less disinflation pressures coming from the emerging world.
Alan, thank you so much. Greatly appreciate that. Alan Ruskin with Deutsche Bank, too short a conversation. Their chief international strategist. We could have gone an hour there, but we can't just because of the crushing news flow. We want to again welcome all of you on radio, on television, worldwide. This Jobs Day, yes, on a Good Friday within Passover, Jobs Day, and it is a statement on a resilient American economy out of a horrific year and a horrific pandemic. Good news with futures up 20, Dow futures up 160 in the bond market, acting like a bond market should. Michael McKee leading our coverage here on the economic ramifications here. Michael, just bring over one single moment, one single set of statistics to this new phrase, a boom economy. Which is the horse, which is the cart?
Well, the economy is booming because it's restarting, and that's why I say restart instead of recovery. Jobs that they didn't have to leave. It wasn't that all these companies went out of business because they were running a bad business. So as we restart, we're seeing more and more people coming back. And of course, the service industries were the ones who took the biggest hit. And we see 597,000 additional service industry jobs produced this last month compared to 53,000 for manufacturing.
This is a distinction that's important. Heidi Shierholz, Economic Policy Institute, a liberal think tank. She will say there's 7, 8, 9 million out. We got to reemploy them. But a real count extrapolating out after this crisis is 12 million people to get us back to what we feel is good. Are you raising up your guesstimates of how many can be employed in this boom economy cycle?
Well, I don't know if you need to raise estimates because we saw that when you look back at February of 2020 and we see how many people are employed and a 3.5% unemployment rate. We can, it's been shown, get back to that.
We can get back to that.
The official number I just calculated is 8.4 million jobs short of where we were in February of 2020. 7,626,000 of those are service industry jobs. So if a lot of those come back in the next couple of months, then we could get there maybe more quickly. And Heidi's adding in the discouraged workers.
Romaine Bostic says this is too much economic talk. Romaine, save us.
Well, too much economic talk. We can keep going on the economic talk, but the market is reacting to this economic talk, Tom. I mean, you're talking about futures are rising here on a day where most people are actually gone. Most people probably already shut down their Bloomberg terminals. You're seeing a reaction here in the bond market. And, Mike, a lot of this has to do with the idea here that not only is the economic recovery strong, but there's some potential here that we could be at the start of a different type of economic cycle. How much can you discern from this report about that?
I would just say we are in a different economic cycle because this is a recession that we had not seen before, or at least not since data has been collected. You go back to 1918 and the Spanish flu. But we're seeing we saw a very, very rapid drop in employment, and now we're seeing a very, very rapid return in employment. And what we could see going forward is, again, some of these million job months, it could bring forward the number of jobs. And then the market is going to start anticipating that with more people at work and more paychecks, they're going to be able to start spending more money, and that should be good for corporate earnings. The one thing that we don't see in this report, because we noticed on the payroll side that the decline in the average hourly earnings, we don't see any inflation pressures in this report, but Wall Street may want to extrapolate that into their thinking because of the fact that the economy may restart faster than they expected.
Gaming out through the next couple of months, Mike, what are you going to be looking for to determine whether other sectors that perhaps didn't see the big employment hits are bringing workers back on or even hiring anew and giving legs to this economic boom?
Well, I think one of the most interesting categories is manufacturing, because we've had, as Alan was talking about, the incredibly strong PMI reports that show manufacturing booming in the country, and industrial production is up, and we sold a ton of cars. Now we're going to have a couple bad months because of the chip shortage, but we're not seeing manufacturing employment rise as fast to the levels that it was, and it doesn't seem to be going up as fast as the PMI indicators would suggest.
Interesting.
So are we seeing more automation? And part of Joe Biden's plan is to bring more factory goods to the United States, more manufacturing capabilities back to the United States. But if they do that, are they going to add workers, or are they going to add machines?
Yeah,
that's something to keep an eye on.
That's a huge story going into next year. Michael McKee, thank you so much. On this Jobs Day, Mr. McKee parsing out the data, and he'll continue to look at that through the morning. Futures advance. The market just simply voting up 18, up 22, and now up 26 on SPX futures, 4,036. The Dow up 210 futures points, 33,250. NASDAQ with a lesser percentage move this morning. On policy, Henrietta Trace joins us, Veda Partners Director of Economic Policy. Henrietta, the policy boom and the $2.2x trillion wish list of the Biden administration, what is the likelihood of that becoming law later this year?
Good morning, Tom. Thanks for having me. What a great job today. I think the odds of that bill are rising based off the rollout that we saw in the last week and the way the administration has sort of self-negotiated to bring it to a package that can really get 51 votes in the Senate and the commensurate number of votes in the House. So my odds have risen on this bill passing from 70 to 75%, and I anticipate it'll go further from there as we continue to work through the details of getting this bill into legislative text.
Do you expect $2.25 trillion to be the end headline number?
Good question. I don't. The bill started off at about 4 to 6 trillion. They cut out half right out of the gate, so now it's 2.25. There's a lingering question about whether $400 billion and some energy tax credits will be tacked on. But I think at the end of the day, the spend in this bill is going to be closer to 1.5 trillion, maybe 1.8 or 2 at the high end. You're going to have to thread the needle between acceptable tax hikes versus acceptable deficit increases versus acceptable spend. And I think that's going to ultimately drive the cost lower. So we effectively fade the bill from here, as one of our very smart clients said this week. And I really like, so I'm going to steal that line.
So let's go there and let's talk about the tax component. Are you saying that it is unlikely that we will get the full tax increase on the corporate side from 21 to 28% and on individuals earning more than $400,000 a year?
Absolutely. So first of all, the individual side has been taken completely off the table. The Democratic Conference does not have the votes to raise taxes, even on estates over $3.5 million. Raising capital gains is extraordinarily complex, even though it's a huge revenue raiser. The wealth tax, obviously, is dead in the water. So all of the individual side tax hikes that folks had been anticipating since the election of Joe Biden are, in line with our expectations, entirely off the table. They'll reserve that for a bill they talk about in the back half of this year, but that bill's not going to become law. So all the individual rates should be expected to stay the same, probably until the 2017 Tax Cuts and Jobs Act expires in 2025. The corporate side, though, I can't find you 50 votes for a 28% corporate tax rate. That would generate something in the range of $1 trillion over 10 years, but the only number I can find you sufficient votes for is 25%, and even that is still a long shot. We did raise our odds there. My expectation is, I think, roughly 30% that we get a 25% corporate tax rate. That gets you $400 billion over 10 years. If they feel like they need to pay for this bill, which is not a given yet, then maybe the corporate tax rate gets increased. But the piece I'd be most focused on is intangible earnings offshore, the GILTI tax that they created in 2017. That is very much on the list of things that could get a hike as they write this bill.
And how much of an impact would that have, Henrietta?
Raising the GILTI tax to 21%, which is just one component of the bill, and changing to a country-by-country basis and a couple other things, is estimated to get you somewhere in the range of about $300 billion over 10 years. And that sounds like about the right number for what they'll want to raise on the revenue side to offset a portion of the cost of this bill. I think the most important thing to remember is that Democrats strongly believe that there's a massive multiplier effect in investing in infrastructure.
Henrietta,
So
you mentioned dead in the water. Let's measure the dead in the water right now. What is the actual power in the Senate, in the House, of conservative Republicans appalled by this spending?
I really don't care about the conservative Republicans too much. They were never going to vote for this bill anyway. So I focus much more on the moderate Democrats. I'm thinking of Kirsten Sinema in Arizona, Joe Manchin in West Virginia, and a couple of others. There were 8 Democrats who voted against the minimum wage tax hike earlier this year in the COVID relief bill. Those 8 people are my main area of focus. I want to know what their deficit appetite is. I want to know where they land on some of these tax credits and the infrastructure spend. I think earmarks will help us get this over the hurdle, but I care more about them than anybody else right now.
Henrietta Trace, thank you so much with Veda Partners today on the policy of this boom economy. Again, we welcome all of you on radio and television, and yes, markets are on the move. Futures up 25. Romain Bostic, thrilling to have you with us this morning. And I go, Romain, to the idea of this boom jobs report. Maybe we get another one in 30 days, and you wrap it into the earnings season that will be in progress in 30 days.
Yeah, really, this is going to be about sustainability. This is a great report, obviously, but you want to see 1, 2, 3, 4 of these put back to back together to really get more confirmation here of the trend line. You dovetail that with some of the expectations for corporate earnings, Tom, and then you get an extension of these.
And Lisa Bramowitz, I thought Dr. Larian was brilliant out on Twitter, making this huge distinction about, okay, it's a boom economy and the elites do well, but where will the new job formation be? To me, that's the crux of the matter for President Biden.
Yeah, there was a story in the Wall Street Journal this morning about the red-hot U.S. economy being a mixed blessing for the world.
Missed that.
And frankly, it's a mixed blessing even within the United States because, frankly, the lower-income workers have typically missed out on the biggest gains at the initial stages of a recovery, and they've been the hardest hit on the way down. Will a Biden plan actually change that? And to me, Tom, it seems unlikely that anything could get passed, certainly before October. And if that's the case, are we just going to see the same thing? Well, I mean, August recession. Then September, they're going to come back, and before they can actually draft the bill and get anything actually done, I mean, that seems to be what people are gaming out when you look at congressional analysis.
They got to break this up. This is going to be smaller bills, and they're going to attach this to something else. There's no way he tries to push this through as one big package because it's just not going to pass.
But in the meantime, Tom, it is a 2-tier economy, and the question is, can we widen it out? Yes, Tom.
Romain, are you giving her grief? Pharaoh never gives her grief.
I don't. Really? I watch the show now. I know what goes on.
My deepest sympathies. You know, Lisa, I look to wrap this up, and we're going to move forward and join us in the next hour as well. We'll talk about that in a moment. But Lisa, it is just remarkable to see where these levels are versus Valentine's of a year ago. I mean, we've really lost touch with what we used to be normal.
Well, the Citigroup Economic Surprise Index really says it all. You saw the biggest economic surprise ever on the way down. You saw the biggest economic surprise in the way up. And here we are trying to gauge out what will inevitably be yet another economic surprise, and people expecting that the surprise will only be to the up.
Well, our surprises were here today. We welcome all of you across this nation and worldwide, particularly Francine Lacroix in London, where they somehow have 2 days off. I don't know what that's about. I'll be with Kaylee Lyons Monday morning here. Why am I on Friday and Monday and Lisa's not? What is that
I'm right
about?
here. Hi. Okay. I'm right here. Come on. You can't complain about me. You can complain about John, but not me.
I got futures up for Romain Bostic, 25. Dow futures up 181. NASDAQ a little bit behind on a percentage basis, but really a remarkable set of futures. Again, stocks not trading. Bitcoin wants to go to 60,000, not there yet. In the yield space, as they say, a 2-beat move on the 10-year yield. Coming up, without question, our conversation of the day. Martin Walsh will join us, U.S. Labor Secretary. Marty Walsh on his president's boom economy. Marty Walsh on the fact that the Boston Red Sox are ahead of the dreaded New York Yankees. Stay with us. This is Bloomberg.
Madame Lagarde, has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly playing at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim. We're going to be riveted to that, and we're going to do what is required.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
When the year is all said and done, we'll see the United States economy growing at a more rapid pace than China.
We're going to have a strong year. We're going to see some really strong job numbers.
There really are some limitations as you grow at speeds that you haven't seen in more than a generation.
This could be a shorter but hotter cycle.
If the market's pricing in a Fed hike in early 2023, it's pricing in the continuation of growth.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
916,000 new jobs, the biggest jobs gain in 7 months. Boom time in America. Good morning. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, Lisa Abramowitz, John Farrow out. Romaine Bostick very much in. And thank you for being with us. Wow, Tom, what a big number. This is much better than expected. A little bit behind some of the biggest expectations, but still a hot trajectory in a new era for the United States.
And beneath the headline data, Lisa, there's always important nuance. And Michael McKee is, of course, expert at the nuance. Futures up 21, Dow futures up 168. But Michael, you've parsed out the reams of data, and you go service sector versus manufacturing. What's the distinction?
Well, let's run through the numbers. As Lisa said, 917,000 new jobs created during the month. 2-month payroll net revision adds 156,000. We end up with 1,072,000 jobs that we did not count in the month of February. So overall good. And the composition of that is the services manufacturing breakdown. Manufacturing 53,000, 597,000 service industry jobs, and about 258,000 of those came from the restaurant and bar sector. So a lot of people who had seen their employment go away when the lockdowns came are being able to go back to work right now. Unemployment 6%. The U6 rate, we didn't mention that in the last hour, was 10.7%. That's a significant drop as well. And the participation rate just ticks up a little bit, 61.5. So we are seeing people go back to work.
Right.
And Lisa, I got to point this out to you. 144,000 men dropped out of the labor force in March, but 500,000 women came back into the labor force. So the fact that the pandemic hit women harder than men is what's it's starting to change here.
Well, yeah, and especially as people go back to school and as we start seeing some of these jobs come back on. Romaine, this has been sort of the key question, though. How much is this just going to be people coming back into the labor force who are knocked out versus a real recovery? And the markets are speaking.
Yeah, absolutely. And I think when you look at some of those longer-term metrics, or at least the metrics in this report that give you sort of a longer-term outlook, the laborhood force participation rate, that employment to population ratio, all of these are trending in the right direction, and that has to be bullish for this market. You're seeing that reflected in the numbers today. But more importantly, and I'm glad that Mike brought up the gender issue here, because a couple of months ago we were talking about all of the losses, the job losses that we've seen with regards to women in the workforce. The fact that they're coming back, it's no coincidence that this is coinciding with the rollout of the vaccines, and more importantly, with the reopening of schools, the reopening of daycares, and getting people back to work.
Well, and Mike, weigh in on that. I mean, how much are we seeing those daycare workers and teachers coming back in?
We're seeing a significant number come back in to the education component of it. Had those numbers in front of me just a minute ago. More than 200,000, I think, we're looking at in terms of people who have come back to the schools, and a lot of that is not just teachers. All the cafeteria workers and the custodians and people like that coming back, and that makes a big difference in terms of the number of jobs that were created or that were repaired during the month.
Yeah, one of the amazing things about having you on hand, Mike, is that you speak with economists across the world. You also speak with a lot of Fed economists. Are we seeing the beginning of huge beats when it comes to the labor market, or are we seeing the peak?
Well, the consensus is we're starting to see the beginnings of a huge rebound in labor hiring because of the way the economy shut down. This isn't a case of the economy trying to gear itself up and start to grow faster, at which point you add workers. It's a whole bunch of businesses that were shut opening at once, and so maybe bringing back their people. So as we see the next couple of months go by, particularly the weather gets warmer, people go back to restaurants and bars, and they start doing more stuff at amusement parks. We'll see more hiring. You get somebody like Neil Dutta at Renaissance Macro, who has already emailed me that he was right, who said we'd have 7 months in a row of seven-figure job
let's stop
creation.
there. This is really important. We make fun of Neil Dutta, but the optimists here, Michael, have really been dead on, haven't they? I mean, it's just extraordinary how the gloom crew's been pushed aside.
Yeah, I mean, we had an official consensus forecast of 650,000 jobs, but as we mentioned, the whisper number, the expectation of people on Wall Street was 800,000, and we did better than that. Tom's doing the whisper number again.
Michael McKee,
we should have a segment on that every month where Tom whispers.
To this day, I don't know why Bloomberg doesn't have a survey on the whisper number. Michael McKee, thank you so much. Romaine Bostic, Lisa Bramlett, and Tom Keene here on a jobs day, and we drive forward into the next quarter. What does it mean for bonds? What does it mean for equities? We're thrilled to have someone with us working in crime with Jason Trennert over at Strategas Advisors. Thomas Satoris runs fixed income for Strategas, and for Mr. Trennert, we're thrilled that he could join us this morning. I love your research note, and you see not one, but you see two tantrums of 2021. Define, Thomas, those two tantrums.
Yeah, well, the first one was what we've witnessed to start the year, where we've clearly seen about an 80 basis point jump in 10-year Treasury yields. And that was really driven by inflation expectations. Now, we do anticipate that we're going to have a second one in the second half of the year, and that's going to be driven by also inflation expectations, but really the enormous amount of stimulus and reopening optimism that's been discussed here. It's interesting. When growth is scarce, the bond market has no reason to ration capital. But when growth is ample, that's when the bond market begins to ration capital, and that's what we're seeing right now. We think that continues throughout the year.
Yeah, we've seen this already here. I mean, on this day, we're looking at 1.7 on the 10-year yield. We got up earlier this week around 1.77, 1.78 here, and we saw buyers come back into this market. There seems to be a threshold here, at least in the short term here, Tom, where people are willing to sort of buy as long as they have a sense here that they're getting a little bit of a return.
Yeah, that's absolutely true. And particularly for non-dollar buyers, whether they're looking at absolute yield differentials or currency hedge differentials, there's a value proposition here with U.S. Treasuries, which is quite substantial, much bigger than we've seen over the last, we'll say, 5 years. But what's interesting is there's been a boycott by many of those buyers. Now, one reason we believe there's been a boycott, particularly from Asian-based buyers, is because there's been a pushback on this enormous amount of stimulus. Essentially, these buyers have been saying you've got a reopening economy, which itself, without stimulus, is going to be growing somewhere between 6 to 8%. And now you're adding enormous consumer stimulus. Yeah. So that's going to be dollar negative, and that's going to be duration negative. And so buyers have backed away. And that's important because until those buyers decide that we've seen kind of the end of the stimulus parade, I think you're going to continue to see buyers, more or less from Asian buyers, kind of just dipping their toes in there, but not really buying with full force like we might expect given the value proposition we see now.
Yeah, and so over the last few months, there's been a little bit of a sweet spot here for investors. But now that you start getting these positive economic prints, you start to see the tick up in yields here, you have to at some point turn your attention back to J-Powell, back to whatever they're going to be negotiating down there in the Eccles building, and whether that might actually be the disruptor, the speed bump in any sort of further rally.
Well, yeah, absolutely. And what you're mentioning is that the Fed plays an enormous role here in the speed with which yields rise. And one way the Fed could play a role has been yield curve control. Now, Jerome Powell has said, we're not going to engage in any sort of yield curve control. We're going to let this curve kind of operate on its own and kind of steepen on its own. And because of that, there's going to be some tension, in my opinion, between the Powell Fed and the Biden administration. How that plays out in 2021 will be the big wild card, in my opinion.
So, Tom, when does 10-year Treasury become a buy?
Well, again, if you're an Asian buyer or a European buyer right now, value is there. If you're a U.S.-based buyer, we would argue that you probably want to see 10s push above 2% before you're going to want to lengthen duration. Most of the clients we talk to are still short duration versus their benchmark, and they're really not interested right now in buying into this market, especially when they consider that, as again, you have a reopening economy which is just beginning. And that consumer stimulus, we'll say 400 billion of consumer stimulus, is just hitting wallets and is just hitting small businesses and big businesses alike. So until that begins to filter through to growth, I think U.S.-based buyers are going to also continue to boycott this. So at 2% is a level, I don't want to throw it out there as a hard number, but at 2%, now you're talking about treasuries being on the high end of exceptional cheapness versus alternatives. And that's when buying probably steps in.
Tom, you've got the most important paragraph I've seen of the week. I'm not going to mince words, folks. The source way out front of debate. And you are going to the summer of our discontent of Jerome Powell. You are looking out to August and September. And, you know, we can do the parlor game of if it's going to be Powell for the Fed for President Biden. But what you state starkly is it will be a Powell that will have negative consequences if he exits. Discuss that.
Yeah, well, so I think first of all, I think Powell has done an exceptional job as Fed chair. But that aside, you're very likely looking at another bond market tantrum in the third quarter here, particularly in the mid to late third quarter. That would be the absolute worst time to send a message to the market that you're going to replace the Fed chair. We got a situation where the dollar might be weakening again, the curve is steepening, and you're going to send a message to foreign buyers who have been reluctant to step in here. You're going to send a message that the Fed is going to become a political casualty of the 2021. That's, you know, in my opinion, that's not a good signal. So we're very concerned, and just unfortunately, because of the timing of when a new Fed chair would have to take the helm, that announcement probably has to come somewhere between mid-August and we'll say absolute latest early October. That's just a really bad time. Also, when the bond market trading is thin because of people on vacation. So it's a bad time to be replacing the Fed chair, and we think it would be a bad policy decision by the Biden administration.
Tom, thank you so much. Thomas Tatoris with us with Strategas, their managing director, head of fixed income research. Futures up 17, up 22-ish earlier. A nice lift here on an odd day of trading. Futures up, equity markets will not be open. In the bond market, opening and showing the bond market up 4 basis points, a 1.71%. What you need to know on this Good Friday, we will continue amid a boom American labor economy. The Secretary of Labor next. This is Bloomberg on radio, on television.
With the First Word News, I'm Rishika Gupta. Talks on reviving the nuclear deal with Iran will resume next week in Vienna at a virtual meeting today. Iran and the rest of the world powers still in the agreement discussed a possible U.S. return. Amongst those taking part, the EU, China, and Russia. Iran's insisted that the U.S. must drop sanctions as the first step. More problems for AstraZeneca's coronavirus vaccine. The British government says there have been 25 new reports of blood clots linked to the shot. That adds to the numbers that caused European countries to impose restrictions on that vaccine. In Taiwan, the deadliest train accident in decades. At least 51 people were killed when the train derailed at a tunnel on Taiwan's eastern coast. Railway authorities say the train collided with an unmanned vehicle that had rolled down a hill. The Justice Department investigation into Florida Republican Congressman Matt Gaetz reportedly focuses on cash paid to multiple women. According to the New York Times, the women were recruited online for sex. Gaetz has denied any wrongdoing. Pioneer Natural Resources is expanding in the Permian Basin. It's agreed to buy Double Point Energy in a deal valued at $6.4 billion in cash and stock. It's one of the biggest American oil takeovers of the year, and it comes less than 3 months after Pioneer bought fellow shale driller Parsley Energy. It's a match made in tabloid heaven. The South Korean company that launched K-pop sensations BTS is buying the U.S. media group behind the careers of Justin Bieber and Ariana Grande. Big Hit Entertainment is spending a little more than $1 billion to acquire Ithaca Holdings, the parent of Atlas Music Publishing. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
When the year is all said and done, we'll see the United States economy growing at a more rapid pace than China. The big hope, of course, is that this growth is sustainable, that it's non-inflationary, of course. So there's going to be imbalances, but from a global growth standpoint, the U.S. is definitely in the lead.
Alan, Kevin Ruskin, good morning, everyone, from Deutsche Bank. And, of course, Mr. Ruskin always looking at the dollar. Resilient dollar here with DXY 93 says it all. Off of a bang-up jobs report, up 22, up 23 on futures moments ago. Right now, up 17, 4,025 is the S&P futures level. Stocks not trading here in 12 minutes, but we've got equity futures today and a bond market open as well. Tom Keene with Lisa Bramwitz. Mr. Farrow is off today. Mr. Bostic joining us through our 4 hours, and thrilled you're with us. And right now we will digress. We're not going to talk to Kevin Cirilli, our chief Washington correspondent, about the lead of the Washington Post or the New York Times, or what Craig Gordon is doing with Bloomberg News. We're going to digress and talk about a president comfortable with unions, and particularly comfortable with unions of another time and place. Kevin Cirilli, will the union voter be comfortable with President Biden and his Democrats in 2022?
He sure as heck hopes so, in order to accomplish his legislative agenda. And I think you really touched on something incredibly important right there, Tom, which is that the union voter, not the union leadership, but what's happening with the members themselves. It's why President Biden went to Pittsburgh. It's why he is pitching the green economy, as they dub it, as a mechanism for jobs. And I think that has been very distorted by some of the communicators who talk about the AOC Green New Deal stuff, and they don't talk about what it means to Latrobe, Pennsylvania, Delaware County, Pennsylvania, or out in Ohio and other parts of the Midwest.
Okay, tell us how they are critical to, say, Connor Lamb, southwest of Pittsburgh, or to the conservative Democrats out west. I mean, I don't understand the action plan of this infrastructure bill to bring those people into a Democratic fold, which, frankly, they've become unfamiliar with.
Well, look, I mean, because when you're talking about, lofty, idealistic jargon of the Green New Deal and whatnot and that stuff, you got to keep it simple. I mean, how do you make a microchip? The way you make a microchip is by getting metal, by assembling it, by manufacturing it, and that means jobs. And so the test for these salespeople that are elected in office is, can they connect to the refinery workers? Because all those refinery workers are hearing, Tom, is they want to shut down your refinery and they want to take away your job. And so it's a really nuanced messaging problem for the Democrats as they head into 2022, because when people feel that they've just been whacked in the post-pandemic economy and they're finally fighting for their economic life and their livelihood, and that they finally can almost get out of it, and then they're seeing refineries shut down. Yeah. I mean, that cuts to the heart of the psychology of the American worker and family.
Although, Kevin, it's unclear what the real issue is, and Tom has talked about this, whether we have enough people to fill the jobs that some of these manufacturers are going to want to fill if we do bring manufacturing back to the United States. And we actually said, as Michael McKee was pointing out, that we did not see that robust hiring in the manufacturing sector, even though a Wall Street Journal article recently came out saying that the manufacturing sector openings for jobs has been increasing dramatically. Do we have the labor necessary to bring these manufacturing sectors back to the United States?
Well, the work ethic's there, but I put that question to Commerce Secretary Gina Raimondo yesterday. Now, she, of course, prior to joining the administration, was the governor of Rhode Island. She also, of course, had extensive work in the private sector with venture capitalism. And look, what she said was, if a mid-career level American has the courage to try to reinvent themselves and the courage to try to embark on a new professional career because their industry has been shifted and evolved into the future economy, then that the government needs to support that courage and that hustle and that hard work. And so retraining, workforce reentry, and not, through free college for all, lofty waste of money goals, but through actual principled, measured strategy is something that Secretary Raimondo told me about, and is something that's going to be crucial to the sales pitch of infrastructure.
Talking about the sales pitch of infrastructure is where I wanted to go. In other words, dovetail this jobs report, which was much better than expected, by all accounts, a bright figure of 916,000 new jobs added, with this idea of selling a $2.25 trillion stimulus plan.
Well, now I'll put back on my Craig Gordon hat for a second, and we'll head back into reporter mode. Look, Republicans are going to say that this is further evidence that they should not be spending more money, that the economy is reopening, that the economy is getting back on firm footing, and Republicans are going to suggest that the only way to keep moving in that direction and to trend in that direction is to continue with reopening. Democrats are going to argue that in order to facilitate that type of robust, inclusive economic growth, that they need to further invest in infrastructure and other projects.
Kevin, I know you're not focused on this mumbo jumbo. You know, I love what USA Today, they says Major the dog has to adjust to his new surroundings. Does Major the dog at the White House, does the Major the biting dog need retraining?
You know,
he's speechless. He's rendered speechless.
This is what I'll say. When I was a kid, I always wanted a dog, but my parents never let me get one. So I'm not going to come at Major. But maybe one day I'll
sit down on the couch.
Kevin, I just
say in Washington, Tom, they say in Washington, if you want a friend, get a dog. So, you know, maybe I need a dog, Tom.
You know, well, I don't know. President Trump had trouble with dogs. Kevin, what I'd recommend is call up Dr. Biden, and you and Major, you know, you can take walks around Lafayette Park as it opens up, and, you know, give the dog some peace and love.
Well, you know, Dr. Biden, I think, is going to be instrumental. I think Dr. Biden has some other things on her to-do list than taking a walk through the park with Kev and Major.
Okay, but, Kevin Major out there next week. Look for it, folks. Kevin Cirilli, our chief Washington canine correspondent,
seriously,
with us today. Kevin Cirilli, seriously, thank you for a Good Friday service with us today. You know, Lisa, I look at this and everybody's digesting this. Don Rismaler, working with Tom Satoris over at Strategas, notices the labor market slack drifts away. For a lot of Americans, you know, I don't mean to go gloom on you, Lisa. I know you expect that, but not all Americans are going to take advantage of $1 million a month.
Well, the idea here, and this actually comes from Mike McDonough of Bloomberg LP Economics, where he basically showed this graph where the people getting employed right now are getting reemployed. These are the temporarily laid off, the furloughed